Everybody, how's it going? Long time no see. This is Benzinga Live. I'm Spencer Israel. My co-host Aaron Bree is joining us from high up in the Rocky Mountains today. Aaron, if you're ready, you can you bring yourself on, or do you need me to bring you on for you? I think you could probably. Oh, he says I gotta do it. All right, Aaron Bree, what's up, man?
What is up? Can you hear me okay?
Yeah, I hear you and I see you. Where are you right now?
I'm at my good buddy's house in Breckenridge, Colorado. Flew into Denver last night. Yeah, Spencer, I heard you had an eventful morning today too, but I'll go over my kind of travel experience yesterday.
Yeah. Well, before you get to that, you left something at the office, man.
What did I leave?
Is that yours?
Credit card?
Yeah.
Does it say world on it or debit on the front?
World.
Oh man, that's my credit card. Now I'm gonna need to actually pay for things out of my own checking account. I hate using my debit card on like purchases because it just goes straight out of your checking account.
Dude, come on! It's sitting right next to me. You left it right in the middle of this.
Well, I left my whole wallet there. I was in my car getting ready to drive to the airport, and luckily in my car realized I didn't have my wallet, and Rohan was nice enough to run it out to me because it would have taken me longer to run from the parking garage to the office back to the parking garage, and it took Rohan to just run it back out. But I guess my credit card for some reason was not inside my wallet.
Man, you and I have had an eventful 24 hours, that's for sure. So let's go ahead and roll that intro, and let's get into it. This has been Benzinga Live. This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher. So.
Let's get meta hammering on the
intro rolling right now?
Jake Wujasek from Trend Spider. We have a
breaking news.
All right. Oh wait. Whoa. Aaron is sideways. And Luke is laying.
I'm restarting my computer
and Luke is laying up against the desk right now.
Can you check my tag?
Can I check your tag?
Yeah, to see where it's from. I sort of like it.
Oh, the shirt you mean?
Yeah.
It's Banana Republic, Luke.
Oh, nice.
It's Sweater Fridays.
It's apparently Sweater Fridays on the office. You know what else is
I
today?
didn't get the memo. But Spencer, we're wearing the same shirt.
Yeah, we are. Well, I wear this every Friday because I have like 4. You know what else is today? Today is Rave Friday is what it is. Going forward here, from henceforth on, every Friday will be a rave in the Benzinga office. If you don't know what I'm talking about, go to my Twitter account and look at what I tweeted this morning because, Aaron, so what the hell are you doing over there?
I'm on my phone right. I'm getting back on my computer. Right, give me 1 second.
Okay. So I'll tell you about what happened to me this morning. So first off, we had some snow last night, so it was like an icy snow too. So I woke up extra early to get here early, and everything was going fine. The roads were whatever. The roads were not great, but fine. And I roll up at around 6:30 or so this morning, and I get to the office and I have headphones in, and I get inside and I'm listening to my music, and I hear, oh boy, we lost Aaron, and I hear like music that's not coming from my headphones, and I'm like, what the hell is going on? So Aaron, are you okay? All right, well, I hope we get Aaron back. I take my AirPods out, because I have AirPods because I'm fancy like that, and I hear like club music, and I'm like, what? And then I was like, oh shoot. Like we have a Sonos in our office, like in the speakers that are in the ceiling tiles and stuff. And I was like, the Sonos is on. And I was like, oh. And I think years ago, I had access to it, and I used to like mess with Jason whenever we would have like events and stuff. I like in the office, he would like turn the Sonos on, and I would always like turn it way down, like just to piss him off. But I took it off my phone. I like just cleaned out my phone one day. I was like, I don't use this anymore. So I deleted Sonos, and I'm unlinked to our account now. And so I don't have access to our Sonos. So I downloaded the app, and in order to log in, I had to confirm, like it detected, my device detected our Sonos here, and it gave me like an email I had to like enter the password for, and it was like, it was started with a D. It was D, like in the asterisk, the rest of it out. It was like D dot 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 at Benzinga.com. I was like, who the hell could that be? So I had no idea who it could be. So I was like, all right, let me just like do a couple things, and then I'm gonna go get some coffee, and then I'm gonna go figure out how to turn this thing off. And so I did a few things, and at around 7:15 or so, I was like, all right, I need to get some coffee. So I went to the cafe to get some coffee, Aaron, and I left my badge on my desk.
Oh no!
And
it was too early. Okay, because it was too early.
I got locked out of the office. Yeah, and I was like, oh crap. So I went to we have multiple security desks. So I went to the first desk, and she's like, all right, I have to call the engineer. I was like, engineer? Just scan me. And she's like, I can't do that. I was like, all right, fine. Then I went to the desk downstairs, and I was like, I'm locked out of my office. Can you please let me in? And she was like, I'm going to call the engineer. And I was like, no, don't call the engineer. She just called the engineer. Just give me a guest badge. And she was like, oh, well, hold on a second, sir. Did you leave your badge inside, or are you locked out of your office? And I was like, I left my badge on my desk in my office. The lock is fine. My badge is not on my person. And she's like, oh, well, that's a big difference, young man. It's a difference between being locked out of the office and leaving your badge. And I was like, all right, fine. You're right. I'm sorry. I left my badge in the office, and I can't get back in. Please, someone let me into my office. So at this point, it's like 7:35.
And no one, like Luke wasn't in the office yet? No one?
No one is here. It's just me. So I get back in finally, and now I've got the Sonos. It's still going. Right. And I was like, damn it. So I call Aaron Thomas, and he suggests like it's playing from Rohan's computer, which it's not. And then I call Rohan, and he actually tried to help me. He was like, well, try going on Spotify and connecting your phone, like change like through the Bluetooth, connecting your phone to the Sonos, and that didn't work though. And I was like, okay, well, who do I think did this? Who do I think was playing the Sonos last night? It was probably Michael Murray. Let me call this guy. And I call him, and he's awake. And I was like, dude, were you playing Sonos last night? He was like, yeah. And I went, it's still playing. Turn it off. Because like I couldn't function. It was loud music. It was loud, and it was blasting. And I couldn't do anything. I wasn't gonna be able to do the show this morning because I couldn't hear myself think. And he's like, okay. He goes, one second. And then he goes, is the music off? And I went, no. And then he goes, okay, how about now? And then it stopped. And I just hung up on him. And then so at this point, it's 7:45. I'd been here for a little over an hour. I had been locked out for about a third of that time. And that was my morning, basically.
So
Spencer,
what I don't get
you know how my morning started? It was
with me calling you.
Yeah, it was hearing your beautiful voice, trying to fix the Sonos.
But what device was it playing off of? It had to be a device in the office.
No,
that's what I don't. I think it was Michael Murray's laptop, but I think he thinks because he shut it or something like that.
So I don't quite understand how Sonos works, but it was playing from his laptop, which was in his apartment, which was like a mile away or a half mile away. So I don't know. I thought your Bluetooth had to be like connected like within Bluetooth range.
You just have to be on the Wi-Fi. It's not Bluetooth. You just have to be on the Wi-Fi network, which I still don't understand how that worked from the apartment.
I don't get it either. Anyway,
that reminds me of the touch tunes thing they have in bars and whatnot.
Yeah.
Where you can like get on your phone and play music from the jukebox at the bar through the app.
Yeah.
There have been like funny times where people play pranks, whether it's like say like an Alabama football song, and they'll start playing it like in Auburn bars, and that happened after the St. Louis. After the Blues won the Stanley Cup back in 2019, we had a song during that run, Gloria, and people were playing Gloria in like Chicago bars and stuff through touch tunes, and people were getting really upset.
That's pretty funny. No, so the moral of the story is that we need to uninstall the Sonos from this office because
Trent's saying the moral of the story is short Sono. I don't know.
I would love to. Trent, I would love to short SONO. I like just a revenge short. I'm so angry at this company. So I tried to because I downloaded the Sonos app, right, and I couldn't log in, but I went to their support page, and first off, their support is only open from 9 a.m. to 8 a.m. Eastern time. I'm sorry, 10 a.m. to 8 a.m. Eastern time, and so it's at this point it's 7 a.m. So I couldn't talk to anyone. So I talked to the chat bot they have, like they have those like robots you can like talk to, and I said turn off Sonos. And it gave me a few options, none of them which were helpful. So I typed turn off Sonos, and I did that 3 times, and then I just gave up because I can't talk to a robot at 7 in the morning. So anyway, that was my morning. I want to hear about your adventures, though, because you also had an adventurous journey yesterday / today.
Yeah, so yesterday flying out. So basically so one of my good buddies has a house out, or his family has a house out here. His dad actually might join us on the show. I talked to him about it. His dad's a financial advisor at Morgan Stanley. But anyway, a bunch of us were flying out from different places. Of course, me and another buddy from Detroit. We're gonna fly out of Detroit. Some people from Chicago. The guys that were flying out of Chicago had to like change their flights because there were storms coming from Chicago. But my buddy from Detroit that was supposed to fly yesterday, his flight got canceled. I thought my flight was going to get canceled. It hadn't. I left the office yesterday around like, I don't know, 3:30 p.m. maybe. I don't know. But it was like you said, Spencer, icy rain, like the highways were slick. People were only driving 35, 40 miles an hour.
Oh yeah.
So I was worried about missing my flight. But when I got to the airport, security was 100% empty because every other flight had been canceled. The guy scanning my boarding pass was like, "Are you sure, man, your flight's not canceled?" And I was like, "I don't know. Apparently it's not." And then we got on the plane, sat on the tarmac for 2 hours, which is like one of my biggest pet peeves. Like if you're going to delay with my flight, at least let me hang out in the terminal and like get food, whatever. Don't just make me sit on the plane, like in a cramped plane for 2 hours before we.
Yeah, because like in the terminal, you can at least like stretch and you can get up and walk around.
Yeah, and plus I was in a window seat, so I was like cramped in the back of the row. So if I wanted to get up and walk around, like people would have to get up for me. So it was a disaster. I was worried for a second the whole flight was going to get canceled. I wasn't going to make it, but eventually we finally took off at I believe about 6:45 p.m. when the original takeoff time was 4:45 p.m. But yeah, man, I mean, it was eventful. It was stressful, but we made it, and I'm glad to be here, and I'm thankful that I'm able to join you on the show today from here.
Yeah, I'm grateful for you today, Aaron. And no, Shelly, it was not Bree who left the music on. I blame Bree for a lot of things, but I knew that it couldn't have been him that have left the music on overnight.
I could have only wished to be able to be that
much of a troll
from thousands of miles away.
Yeah. And sometimes when I get here, I'm not the only person. I'm not the first person here. Today I was the only person here until about like 8:30. So I'm just by myself. And I was prepared. I almost called Joel and Dennis, and I was like, guys, I'm not doing the show today because like
this sound is
I can't. And everyone that I told to, they were laughing. Everyone thought it was funny, except for I still don't think it's funny because I was stuck here. Everyone else thinks it's hilarious. I'm glad you all think it's funny.
Could you imagine if because sometimes Jason gets to the office really early. If it were Jason, he would have been freaking out.
Oh God, that would have. I mean, yeah, that would have been not good. And so whoever keeps asking, why don't you unplug it? There was nothing to unplug. It's playing through like it's connected through an app. And our speakers are in the ceiling tiles. There's nothing to unplug. I don't know. Whatever. Sort SONO. Revenge trade the crap out of this stock. Okay. So here's the deal for today. We have a bunch of guests lined up. We have Jesse Kaler who's going to come on in a few minutes. We have Tim Quast coming on today. I'm very excited to talk to Tim, as always. We have an interview with the CEO of ticker INST, right?
Instructure. Yep.
Yeah. Tell us about that one.
Yeah, so like you mentioned, we've got the Instructure CEO coming on, Steve Daly. Instructure is most well known. I believe they have other products and services under, the company, but the main thing is Canvas, which is the remote, online learning platform that's used through a lot of universities. I don't know about you, Spencer, but I used it in my university, so I'm excited to talk to Steve about that. And see kind of, because what I'm really curious about, right, is the company, it's one of those services and companies that grew a lot during COVID.
Mm-hmm.
But what I'm curious about is we switched. So where I went to school, we switched from Blackboard to Canvas. And this was well before COVID. This was in like 2017, 2018. So there has to be something about Canvas that makes schools want to switch to it. And I'm curious if they can keep some of that momentum going beyond COVID, or is this going to die out with a lot of the other COVID plays, right? And speaking of that, Spencer, I know we got Jesse Kaler going to join us, but
Yep.
We got to talk about Roku real quick.
Man, it's getting brutalized out there. So Roku did the one thing that you can't do if you're a growthy tech stay-at-home play right now. The one thing you can't do, and that is, well, I mean, you have to if that's the reality, but the market does not want to hear anything about slowing growth. If you talk about growth slowing down, they're gonna punish you. The biggest thing from Roku here, and I'll go to the news feed in Benzinga Pro because their earnings were out last night. You really want to pay attention to their guidance. It's not so much the earnings. It's not the stuff from last quarter. Look at the guidance. The Q1 net sales guidance came in below estimates, and then they gave EBITDA guidance that was so far. I think a year ago, their adjusted EBITDA was like $150 million. And they're guiding adjusted EBITDA to be 55, down from 150 a year ago. So their EBITDA is going in the wrong direction. It's not growing. Again, that's earnings before interest, taxes, debt, and amortization. So their EBITDA is shrinking, i.e., their growth is slowing. That you can't do that right now. They will punish you for it, and they're punishing Roku for it today. 40 million shares are traded. It's down to $108. Let's go back out further. Let's see how far back do we have to go, Aaron? We have to go back to June of 2020, the last time Roku was here. It's brutal.
Yeah, I mean, and that's what I think is so interesting right now about some of these growth stocks. And I don't want to go fully off topic from Roku. The title of today's show is Roku versus Netflix, because I was expecting to see Netflix trade lower off this news, and it actually did the opposite, traded higher. And I don't know if there was another, we can check Benzinga Pro to see if there was another headline in that for Netflix to see if there's a cause for that move. But this might be a case of sometimes you have these sympathy plays that move together, they move down together, they move up together. But sometimes if they're in the same industry and one stock or one company showing weakness, you'll see investors kind of flock to that stronger company that's in the same industry. And I'm curious if that's what we're seeing going on with Netflix right now.
Well, sometimes, yeah. I'll pull up that Netflix chart for you, and we can look at it. I'm gonna say in this instance, Netflix is beholden to the overall market. So there was a pop off the open there, but that pop happened. That was a broad-based rally off the open.
Well, what I'll say on that, Spencer, is Netflix, which it's given up a lot of its gains from today, or how high it was, but it was up higher than the overall market, up higher than overall tech.
Maybe so. Sure. I didn't look, but if you say so, I believe you. Regardless, though, if we just compare this to the SPY let's just do the Qs, and you can just see.
Well, yeah. So for clarity, 25 minutes after open, Netflix was up about 3.5%, 3.6%. The Qs, I mean, we're never up 3.5% today. They were up 0.3% at the open. So I hear you that it's trade with the market, but my point is just that Netflix was up higher, showing that that for some reason people were buying Netflix this morning. I don't know if it was because of the Roku thing, if there was other things impacting that, but I just thought that was interesting because I was actually expecting after Roku's report to see Netflix down again today.
Interesting. All right, I want to bring Jesse Kaler on the show. Jesse, his handle is Elite Trading, and I've been very much looking forward to this. To hear what Jesse thinks about the market, but also
I need to hear what Jesse did with the $10 I've Venmo'd him.
I want to hear about that, but yeah. All right, Jesse Kaler joining us live from Cincinnati, Ohio.
I'll take the shrine down. Hey, what's up, guys?
You took the shrine down. Jesse, first off, I'm sorry.
I'm heartbroken, but it's okay. We lost by 3. We drove down at the end, had a chance to win the game. And you know what? We had more penalties in one drive than we have on all season. So something, sometimes the bookies got to win too. No, I'm just kidding. No, it was a good game, and we enjoyed watching it. So,
all right, I'm glad you had fun. It's not about winning or losing. It's about the friends you made along the way.
Afterwards, I did not talk to anyone. I said, "Oh, there it goes, going to bed." So it was a long day. It was a fun day. But
I mean, there was a point there, Jesse, where it was things were looking up for you. The fourth quarter there.
Yeah.
Yeah.
I mean.
Yeah, I was curious kind of what out of Bengals fans, like how much of it is, because it certainly was like, I don't think it was one of those games that was 100% determined by the ref. But if you are a Bengals fan, then you definitely have an argument that like there were a lot of flags on the last drive.
Yeah. I mean,
or in the last 5 minutes of the game.
Yeah, it was ridiculous. We were like the least penalized team in the NFL. And then we had in the whole game, 50 something minutes, we went with like 1 penalty, I think. And then we had 6 or 7 in one drive. So okay. But anyway, we're shorting restaurant stocks.
That's what I was going to ask you, Jesse. Are you just short everything right now?
Yes.
Yes.
And
he's revenge shorting everything.
And I'm cash, like 70% cash about 2 weeks ago. Thank God. But I only kept in my portfolio. I just got this weird feeling where everyone just kept. My phone was ringing off the hook, and I'm like, man, every time this happens, we get a pullback in the market because everyone's bugging me, and I'm like, so what are we gonna do? I left all my 2023 long contracts that I have that are for like basically lottery plays that I use like 5% of my portfolio to just kind of play with things. One was like SNDL. And I actually got a run up. I mean, my calls were, this is where I just want to make a statement. My calls went from worth $5 a contract to 15 in 3 days. And then today they're worth 12. And I sold a few and I'd been averaging down. And I tell people that, like, if you're going to buy something out for 2 years out and it goes from 50 down to $5, you need to buy some more, if you're planning to hold it. So I bought some. But I tripled my money now on that level, but I'm still down from when I bought them at $50, at the same time. So I'm down like 8% on the total trade on SNDL. But at the same, no one's talking about, and no one wants to talk about, when they sell too early or things like that, or like when they lose money or when they're only averaging down and making some of it back. They're not actually coming back out of the position. And that's the point where today I just was like, I'm just going to get out of it completely. And I'm going to take my 8% loss, put the money back into something different once I feel like it's time. And I've been getting some information about Darden and Texas Roadhouse, like these different companies that have had some really good runs and they've been consolidating for a while, and they all have similar charts where they look like they're going to have maybe a good pullback to get some 50% retracements on those previous moves up to the upside. And I think a lot of it's going to be to do with the restraints for getting the products they need to continue doing business the way they normally do, with having inflation, costs going up.
So that's what I'm curious about. Is the thesis like more along the lines of rising costs for the restaurants, and restaurants don't have, I mean, they have the ability to raise prices to try to meet some of the increasing cost of production, but to a certain extent, right? Like if I go to Red Robin and they have a $10 burger, they could raise that burger to $11, $12, sure, but if they raise it to 15, I'm not getting a burger at Red Robin for $15.
Right.
So I think restaurants are in one of those cases where they're more restricted in how much they can raise prices to take off some of that, to offset some of those costs of rising cost of production. But Jesse, there's always going to be a special sweet spot in my heart for a short trade on Darden. I feel like I've told this story a million times, but I worked at a Red Lobster in college. Darden used to own Red Lobster, doesn't anymore. But right on the onset of COVID, kind of when I had first gotten into trading, I shorted Darden because I was still in like our Facebook employee group, seeing what people were saying about what was going on at the restaurant, and made a lot of money on that short. And that was what kind of like hooked me on options trading, was shorts on Darden.
Well,
some margin.
and there's like a guy that I know that owned, not owned, but he's they call them something different. They're like lead managers of the district, and they get stock, and they have like they earn money by, if the store does better, they actually make money. It's not like a front of house manager, if that makes sense. He's like a general manager, but with a different title. But he was saying, he's like, yeah, because he knows I'm in the market and I trade. He goes, what do you think about Texas Roadhouse? I was like, I've never looked at that stock before. I said, I'll pull it up. I didn't even know you were publicly traded. I said, I'll take a look at it and I'll see what I think. And I said, from what it looks like you guys have been making nothing but money and happy. I said, is there a catalyst? Is there a reason? And I said, well, looking at the chart, I said, you've had nothing but just greatness since 2020. So maybe for me, technically, I said, I'm just looking for a pullback. If I was an investor to get in, I don't see any opportunity to buy it for the long side. And then he said, well, I've been waiting for it to go down. And he's like, I've been thinking about selling because of the supply chain issues and with not being able to get the things that they're needing, and the lack of employees wanting to work. And if they're going to raise the wages up for servers, that's a big cost for restaurants that they've never had to procure before. They've been paying these people $2 an hour for 50 years. So if they start having to pay servers $7, $8, $10 an hour, that's a huge difference. You're talking 10-time multiples, 5-time multiples with just a single couple bucks.
Yeah, and I will say, Jay Rice in the chat pointing out that a lot of these food stocks, whether you're talking about Cheesecake, Bloomin' Brands, Chipotle, are all green in a kind of rough market today. So there could be some relative strength shown in those stocks. I don't know. But
or is it just short term because they're just not maybe something a little safer right now?
I think that's it. I think on the spectrum of risk, technology is way to the end, and restaurants are a little bit less so. So
well, that's why. So this conversation's reminded me of Jesse. I don't know if you were listening, but a week or two ago, Spencer and I went through all the holdings of Pershing Capital, Bill Ackman, which was only 7 stocks. And about half of them were food. What, Spencer, do you remember off the top of your head? I know Domino's Pizza was in there.
He's got Chipotle.
Domino's is amazing.
He's got Chipotle. He's got Domino's. He's got Howard Hughes. And that's all I remember off the top of my head.
So if you say to Chipotle and Domino's, those two are basically, in my opinion, they're in their own realm when it comes to the restaurants, because nothing's really ever performed the way that those two have in the restaurant. You're talking hundreds of companies, and these two are they've just done nothing but really great when it comes to owning shares for those companies. I mean, look at Chipotle.
Well, yeah. It's funny you meant that these two. I mean, Domino's and Chipotle.
I remember when Domino's was going out of business. I remember when they were going out of business, and there were every one of them was closed down. Everybody I knew hated the pizza. And
do you remember when they revamped like their whole menu?
Yeah, but I didn't realize that the franchisees, they were killing it. Like, even though people didn't like the pizza and they were dying everywhere I saw, somehow they were making money eventually when they did this rebrand. And they did well since, I think it's probably been about 8 or 9 years, 10 years since they rebranded. And
and in that time, over the past 10 years, I think Domino's is if not one of the best performing stocks over the past 10 years, which is just incredible to think about. I mean, you have think about companies like Apple, Microsoft, Amazon, Google, and it's like Domino's is the best performing stock over the last 10 years, but over the last 20 years, it's Monster. So maybe there's a theme there that it's food related. But yeah, Domino's started a business plan a few years back where they said, okay, we're going to try to get as many, even if they're really small locations, just in as many like street corners as we can, because they wanted to have it that no matter where you were or what part of the city you were in, you could get a Domino's pizza within like 30 minutes. So they've had a lot of success with that, where instead of having say like 5 full-fledged locations, they'd rather have like 10 or 12 smaller ones that they just know they have a wider radius of more delivery options.
I think we'd be remiss not to throw Shake Shack into this conversation. So for a long time, Domino's, Chipotle, and Shake Shack were the 3 restaurant stocks that, for whatever reason, got assigned a higher multiple than the rest. And they were, I mean, they've been very cyclical, but those 3 have had huge runs at various points. Shake Shack reported earnings last night, and you can't paint every restaurant stock with the same brush, right? Think about like the customer base from a Domino's or Chipotle versus like a Shake Shack. Shake Shack is in downtown areas. It is in areas where that cater to professionals. It is near offices. It's a
Kind of
it's
a
a
celebrity stock.
Well, it's a place you go for lunch on a Thursday, like during work, right? And the reopening trade, while it's been hot in other areas, clearly is not happening here because they said in their earnings report, like, yeah, I mean, people aren't going back to the office, and that's hurting us a little bit. So they actually gave guidance below estimates here yesterday. They said their sales guidance is going to be. They said sales guidance for the quarter in right now will be around $200 million versus a $210 million estimate. I know the stock is actually rebounded, I think, a little bit here today, but again, it different kind of it bounced off the open, but different kind of restaurant stock. Frankly, I'm not really. If I had to guess why it's up from the open, I would say, like we said before, it's not a technology stock, and that sometimes that's all it takes. But Shake Shack's report was not good. To be clear, it was not. This is not the kind of report that makes you feel good about like the near term future.
Does it, or does it set them up for a big beat after this summer? And we have
that's the other side of that coin, right? Are they lowering the
Look at
bar
this monthly
now?
chart.
Are they lowering the bar now so they could destroy the bar later on?
So we've continued. They've made higher highs on the monthly chart, and then they've made higher lows when they've pulled back. This looks like it's ready to maybe go back and try to make an all new high in the next couple of years, the next 2 years maybe.
I will mention because it seems
2024,
pertinent to the conversation that I had Shake Shack last night.
Okay.
So maybe next quarter's earnings. Oh, I also wanted to show this real quick. I don't know if you guys saw this, but a month or two ago, New York Times ran like a story about a guy who was.
I saw this.
Yeah. So the reason it's funny. So it's an option. He's an options trader, Mr. Marsh in Chicago, and he said he left Chipotle because his burrito used to be in the mid $8 range. Now it was more than $9. So you're talking about like a 50 cent to $1 price increase of a burrito, which I don't even know.
I lose 50 cents every day out of my pocket.
I don't even know if Chipotle has raised prices across the board. But what was funny about it was that the New York Times did this whole story, and then Chipotle reported earnings like a week ago, and they said the exact opposite, that we haven't seen any deterrent in customers from like a small increment rise in prices. And it was like this options trader who it's like you should be able to afford $9 burrito.
Right.
You would think so.
Adnan, is this true?
I saw that tweet.
Wait, I saw a tweet?
So no, I'm sorry. I saw that comment. No, so apparently if you go into the Spotify app right now, this is not like an official, it's not from a news source. It's like if you go to the Spotify app, and I'm going to do that right now.
But they sold off on the headline.
If you go to Spotify and search for Joe Rogan.
Did the headline?
I have it. Oh, something went wrong.
What time did the headline come out?
Oh, damn. Me too, Aaron.
Something went wrong. When I pull up another one of my podcasts, it loads.
Short Spotify, everyone. No, I'm just kidding. That's not trading advice, but if you guys want to jump in.
I don't know. I mean, that's surprising. I mean, geez.
Yeah, I'm just alerting
what was the company that you guys just had on here that would be like, hey, I want to take on Joe Rogan if this happened? Wasn't that just, who was that?
Rumble. Well, we had Ben from Story Trading talking about Rumble, which is CTVI, I believe.
See if they go up on this.
Is that what can we get, or CFVI?
CFVI. Sorry, I'm typing right now.
So the Spotify's trading down. For that would be so great if they just were like, and then they announce this and the stock rips to 100. I saw one that did that the other day when I was looking at the market movers, and there was one that moved like 100 yesterday. I forget what it was.
Wait, Alan Verga, yeah. We're always hiring. It just depends on what for. So
They're not
why don't
hiring you to trade for them, I bet.
no, we're not going to hire you to trade for us, Alan. If that's the question, we're not going to do that. We're not hiring traders.
I got first dibs anyway. If Benzinga needs any type of trader to come work for them and start doing any broadcasting or help with some developing, especially your Discord, I'm sorry, you guys need some love there. I can help there.
Whoa, Aaron Thomas. Aaron Thomas is the man who supposedly is. Wait, was it Aaron Thomas? Or no, he's focused on our Twitch.
You don't even know how to run Discord from what we heard, Spencer.
No, I'm not.
You can't even get in there.
What? No, I can get in Discord.
I'm just kidding. Somebody said that, and they're like, Spencer doesn't even know how to work his Discord.
Oh, I mean, I can get in if that's what we're talking about.
It's so binary, but it's I love it.
Wait, I would just say this: Discord is not that easy to use. Okay, can
not
we just
user friendly? It's nerd friendly. I feel like.
Can we just? Yeah,
I mean, computer programmer friendly and developer friendly.
It honestly reminds me of MySpace because I can never figure out how to make my MySpace like cool. Discord gives me those same vibes.
Discord's like you're not supposed to be cool. We're here to make information quick, efficient, and alert process.
You know what was funny was the other night when I was at on Thursday night. Sometimes a couple guys from the office will like go out to a bar to get some work done, get some food, have a good time, And there was a kid who came up next to me. He saw me looking at a chart. He was like a 21-year-old kid, came up and was like, "Oh, what chart are you looking at?" Like all this stuff. And I actually remember it perfectly because it was after Hood's report, and like Robinhood was like making new all-time low. Like the stock was just so ugly. There was nothing from the previous. And I was like, "Oh, I'm looking at Robinhood's chart." And he was mostly like a crypto guy. And I'm like, "What do you see in this chart?" Kind of joking with him because there was literally nothing to see because it was just going straight down, like no lows to the left.
Can I guess? Can I guess what he said?
What did he say?
He said it's forming a bottom.
No, I don't even remember what he said. But my point
it's
was
forming
at
a
one
cup
point
and handle going to the moon.
I pulled up my Slack and he's like, "Oh, what is this? Is this like Discord?" And I was like, "You know what? Yeah, Slack is like Discord.
Slack is Discord for work.
It's Discord for work.
That's all it is. Discord for gaming. Slack's Discord for work.
Slack is Discord, but on nowhere near as cool, I think, in my opinion. But what my safety pick of the year, just as one I've been holding out on, is Procter and Gamble. If you're looking for dividend plays, this is a less sexy, a less aggressive.
Boo, boring.
No, not boo. Keep going here.
Procter and Gamble. If you just look at the chart, look at the 10% yearly dividend that they've been talking about, that I've been trying to read more of because I'm not a dividend expert, but I have people in my group that I usually go, "Hey, tell me, is this going to be a good dividend play or not?" And a lot of times they'll do their analysis and say, "Yes, I think it's a good one or not." And I was told yes on this. So, you know what? We always get a visit from the little ones, and they're breaking in the door. "What do you want?"
Man, kids, am I right, Aaron?
Spencer, you're going to know my feeling. You're going to be like, "How do I do this?" And they're going to be like at the office. Your wife's you're going to think that she's going to just sit at home and watch the kids, but they hit about 2 to 3 or 4, and they're like, "You know what? I don't care what you're doing. They're showing up."
I feel that.
Just get a dog.
Jesse, it's great to talk to you, man. I was very interested to find out what your mental state was going to be today, but I'm glad you have bounced back. It seems like you're just it was a good season and you're happy to be there in the first place.
You should have seen the route. They had a AFC championship parade, like celebration downtown, and it was crazy. They said that I think we had like 10 times more people than that was at the Rams Super Bowl celebration, and it was
awesome.
But she's
all right, man.
Hey, hold on. She's got something on her face for all you fans of Cincinnati. She's got Cincinnati chili. We were talking about that last time we were here. That's what in there eating.
I thought if you won, they were going to turn the river to chili, but I guess
we lost, so they turned the river just to nothing. But Procter and Gamble restaurants are going down. Invite me back. I'll see you.
All right, we'll talk to you next week, Jesse. Have a good one.
Yep.
All right. Okay. Aaron Breeze is here. He'll be back in a second. But our next guest will also be on this.
I was giving our news desk some more clarity. Can you hear me?
Yes.
I was giving our news desk some more clarity on the Joe Rogan Spotify situation, which we will be watching, updating if you're just joining us. For some reason, the Joe Rogan's podcast and Spotify is not loading right now. So Spotify, let's see what the stock's doing real quick.
I mean, it's down. Although it's very difficult today to attribute
it doesn't-
moves. No, it is
because
down.
I think this
What do you mean?
people like this whole thing on Twitter, people talking about Joe Rogan and stuff has come out over the last like 30 minutes, an hour, talking about how you can't get his podcast on Spotify right now, and the stock really hasn't made any moves off that news. It looks like, so we'll see if I assume that the company Spotify will probably come out and say it was just some like technical thing, and then unless I don't know, we'll see.
I don't know. Yeah, but it's difficult to attribute moves in the market in individual stocks to anything other than the macro environment. Everyone just seems very, very nervous today. Not just today, but think about what today is. One, it's an options expiration, which means volatility. Two, it's the day before a 3-day weekend. So that's, people a lot of times, will unwind any long positions, any short-term trades going into 3 days. Nobody wants to be long stocks for a 3-day weekend. In this environment with Russia and Ukraine doing whatever it is they're doing over there, although I did hear that Biden is supposed to speak at 4:00 today about that, so take that for what it's worth. But
just very, very coincidentally, right when the market's closed.
Well, there is the after-hours session.
Let me go get my tin. Let me go get my tin hat on.
Dude, Joel always says that. Joel thinks that every politician, or every speech is done, in confluence with market hours. He thinks everything.
I think there's
come
some truth
on.
to that. I mean, think about like during COVID, we had a couple of times where like Trump spoke, where the market just like ripped, and he would speak at like 2:30 p.m. Eastern and give some good, whatever it was at the time. And it's like if they knew that the news was going to be bad, maybe we push that till after market. I don't know. I mean, I'm not saying whatever.
I don't think that like people are like.
Well, it's 2 against 1. Joel and I both think so. You don't. So
I know. Whatever.
Whatever.
All right.
So we were just talking about Slack being the Discord of work.
Yeah.
Kind of, communication services for work. So now let's segue into some tech communication services for education, Spencer.
Mm-hmm. Yeah. Can I roll my special intro?
We will. We're bringing on Steve Daly, the CEO of Instructure, ticker INST.
We'll give Steve special intro number 1. Hey,
I love
Steve,
special intro number 1.
Thank you,
Spencer.
Thank you. Appreciate that.
Steve,
how's it going?
It's going awesome.
Thank you for taking time out of your Friday to join us. So I saw Instructure. You guys are headquartered out of Salt Lake City.
We are. Yeah.
Is that where you're at now?
That is. Yeah.
Cool. I'm up in the Rocky Mountains, so we're not too far away right now.
Oh, where in the Rocky Mountains?
I'm in Breckenridge, Colorado.
Oh, very nice. Very nice.
President's Day weekend.
Yeah. I wish there was more snow, though. Don't you?
Yeah, well, it snowed here.
You guys got to come where I'm at. You got to come to the Motor City. We got snow we got all kinds of snow in us.
So Steve, before we begin, do you want? So Instructure, it's a newly public company. You guys have been on the markets for what, two months now, a month and a half maybe. Do you just want to give our audience a brief rundown of what it is that Instructure does? Kind of outline Canvas, one of the main services and products.
Yeah, sure. So as you said, Canvas is we make Canvas. Canvas is a learning management system. It's the number 1 learning management system in North America. We have about a third of all higher education institutions are using Canvas, and nearly half of all students in the U.S. higher education system have used or are using Canvas as well. What we do is we really connect teachers with students, with parents in the K-12 systems, with administrators, and we simplify and we automate a lot of those kind of manual processes that teachers and students go through, and really underpin the digital transformation that's happening across the education industry today.
Yeah. So Steve, I think it's very interesting because, obviously, Canvas probably, grew a lot during COVID, right? When
Right.
universities were forced to go remote. But in college at University of Missouri, we switched over from Blackboard to Canvas, I want to say in 2017, 2018.
Yeah.
So before COVID, what's like the big selling point to big universities like that, why they would want to switch? Because let's be real, it's a hassle to switch over your whole management system from one thing to a new thing. So what was the big selling point to say, hey, we're better than Blackboard? Is it all tech based, or what are the selling points there?
Yeah, there's a few things. So, I started with Instructure about 18 months ago. And so we, as a company, we were public, we went private. I came in when we went private. We did a lot of restructuring and re-engineering at the company to come back out into the public markets. When I went and talked to customers, there were a number of things that they said they loved about Canvas and about Instructure. First and foremost, they said, look, we love working with your people. At Instructure, we have nearly half of all of our employees are in customer success, and almost half of those were former educators. And so we really do approach it from an education perspective with we can empathize, we can understand. When we built the product Canvas, right, it's cloud native. It was built in the cloud. Where a lot of technologies like Blackboard were on-prem, old legacy technologies, and universities, K-12 systems, districts, they're all looking for what is going to take me into the next 10 to 20 years. I need a true cloud native kind of next generation sort of technology. And then the third thing is when we approached designing the system, we said, okay, historically, the old systems were designed with the administrators in mind. And we said, let's make this a really nice experience for teachers and for learners. And so, a lot of the feedback I got when I went on my listening tour was, it just works. It's nice. It's intuitive. It's easier for me to use than the old technologies and the legacy technologies.
I'd be curious, Steve, like, the implication of any company that got a huge tailwind from the pandemic is that tailwind has now come off. Now we've seen this across the board in everything from streaming to Zoom to everybody basically. So I'm curious, like, can you speak about that growth rate and how it looks now in this reopening post-COVID world?
Yeah. So, the nice thing is, we reported earnings yesterday. We beat on, all of our metrics for the year. We raised our guidance for next year. And there was this narrative about, okay, is once we go back in class, is everything going to go back and, your tailwinds kind of subside. And I'd say there's two factors that have made that not to be the case for us and for education. First of all was, the digital transformation that was happening in education. It was probably a little bit ahead in higher ed, but K-12, was happening really slowly. And one of the challenges with that transformation was you had a bunch of teachers, right, that had 20 years worth of lesson plans in this 4-drawer file cabinet in the back of their classroom. Right. And to say, hey, let's put those all online. Right. Let's change some of, how we teach and our lesson plans to enable this kind of interaction. Right. A digital interaction was a big lift for them. Well, during the pandemic, they had to do it because that was the only way they could reach a student. So now we're coming back in class and they're saying, okay, I used to have to go to that 4-drawer file cabinet, grab my, my homework assignment for today, go make copies, go hand it out, go collect it, grade it by hand, put it into the grade book. All of that now is on Canvas, right? And I don't have all those manual tasks that were such a pain and took me away from doing what I got into education for in the first place, which was be with the students, mentor, show leadership, those types of things. All those things now are automated through the Instructure technology. And so we're seeing usage on our platform is It's come down a little bit because, when you're in classroom, you don't have to have a Zoom session, right? And so you're not going to Canvas to launch your Zoom session, but still they're doing homework. They're taking tests and quizzes on the platform. And the number of students that have access to hardware increased dramatically during the pandemic. And so now it's being used in class while we're, in addition to, hybrid or fully remote. And so again, we're seeing, good usage of the platform even after the pandemic is really, it's not over, but even as we've gone back into much more in person than we did prior to the pandemic.
So Steve, I don't know if you know off the top of your head, but if not, you can just ballpark. But what percentage of Canvas customers are universities and colleges versus like K through 12 school districts?
Yeah, about half of our users on the platform are from higher ed, and about half are from K-12.
Okay, I would have
Even
expected
mix.
actually a higher percentage of higher ed. But like I mentioned earlier, right? When if even before COVID, with Canvas you're going to school saying, okay, we can be better than Blackboard, whatever. It's a big decision, especially for like a state-funded university, a 40,000 person school to switch over. In some ways, is that a benefit to you? Like once you get these schools locked in, they're like, hey, we're not going to go through the hassle of switching again,
Yeah, no, it is. We have kind of mid 90s gross retention rate, low single digit churn. We've never lost a fully deployed 4-year institution of higher education. And so you're right. It gets embedded into the fabric of how teaching and learning is delivered. The other thing that's interesting in the education market is that it's a highly referential sale, right? Everybody's looking at what everybody else is using, and so every one of the Ivy Leagues is using us. The entire California community college system is standardized on Canvas. Entire nationwide systems in the Nordics have standardized on Canvas. We won 11 of 12 statewide RFPs that were let in the last 18 months. And so we have a very referenceable base. And so as long as you take care of your customer, right, and treat them well and give them the importance that they deserve, because they're doing a great service for society as educators, and then get designed into the business, the processes of how teaching and learning done. It becomes really, really sticky.
Yeah, and a lot of investors. Sorry, Spencer, go ahead.
No, I just wanted to say, like, I know you can't necessarily control this or speak to it, but I can't think of any other charts off the top of my head that look like this for a company that is basically a stay-at-home play here. Frankly, this looks dramatically better than the vast majority of companies with a similar type of profile. To what do you attribute the relative stability here? In the market.
Yeah. There's a few things that we're really proud of. First of all, we are a company that is growing, double-digit growth. We just announced our growth this year was in the 20s% on the top line. But in addition, we also announced that we have 35% EBITDA margins, and so we're a very disciplined company about where we spend our money, make sure we're getting the return on investment, so that we can have both top line growth as well as world-class profitability and cash flow. And on top of that, we aren't seeing the COVID for us wasn't this big blip. And now we're going back to pre-COVID levels, right? It was a fundamental change in how education is being delivered around the world, and so it is. We're still just early days in this whole digital transformation that's happening across education and the way we rethink about how we're using technology in the classroom, and so I think we're still early days in that transition, and we sit right at the middle of that. The LMS touches 90% of all the instructional workflows. And so there's a lot more for us to do as a company in helping to automate a lot of these processes, again, that take away from what teachers are really trying to do in the classroom. And so, a lot of room for growth in a company that isn't burning cash. We're generating a ton of cash, but it's still growing. So it's a unique combination, in my opinion.
Yeah, and a lot of investors really like the kind of recurring revenue model, but a lot of times it's with the caveat that you have low churn and also some substantial growth. So, exciting to hear that you guys have that low churn down. And yeah, it's undoubtedly you have the clout, right, to say if every school in the Ivy League is using us, then
why wouldn't you?
Right, exactly.
Yeah.
That's it.
Well, I am curious, like, how long does it take? Like, what is the sales cycle here, Steve? I mean, it's all word of mouth. Sure, that helps, definitely. But, like, how long does it really take to get into a state university system, for example?
Yeah, it's usually an 18-month sales cycle, right?
Okay.
It takes this isn't a decision that's taken lightly, right?
Yeah,
Because again, you've built a lot of these business processes around that. That's in a higher education, because a lot of higher education institutions already have something. It's interesting in the K-12 systems. It used to be a nice to have kind of this enterprise class LMS. We think about half of the market has a paid for enterprise class LMS, but half of the market doesn't still. And so that's more of a greenfield sale. Sales cycles tend to be a little bit shorter, but again, they're purchased with state funds, right? So it's a very rigorous buying process that they go through anyway. So 12 to 18 months is a typical sales cycle for us.
Because from what I know about education is they move slow.
Yeah, especially the state funded.
Yeah.
But Steve, so we only got 2 minutes left, but I want to touch on a couple things. So you guys did report earnings yesterday, correct?
That's right.
Do you want to walk us just through kind of the highlights of that report?
Yeah. So, on the top line, we reported that for the year, our revenue was up 34% year over year. And we reported 35% EBITDA margins on the business. We're up to nearly 7,000 customers now. That was about a 14% increase in number of customers in 2021. Our net retention rate was about 109%. Built on the backs of that, kind of mid 90s gross retention and low single digit churn. And so really happy about that. We were able to raise our guidance for 2022, and we'll continue to make investments back into the platform. We're expanding our sales capacity. Big opportunity for us is international. We're still, single digit share internationally. And so we also announced a channel program to go after more and more of the international opportunity, which should pay off for the next 2 to 3 years.
Awesome. Yeah, we'll have to keep watching it next quarter, kind of watch the earnings report, get you back on maybe some more updates. But the last thing I want to hit on real quick, we only have a minute, but I'm curious about this timeline of you mentioned Instructure was public in the past, then went private and is now public again. So I know, so was it Thoma Bravo bought out Instructure while to bring it private?
Yes.
So what was the decision then to then take it back to the public markets?
Yeah, there were a couple things. One is there is we wanted our customer base, education, as you mentioned, there's a lot of interesting dynamics in education, but really the visibility that being a public company gives to our customers and lets them know, because there was a lot of worry when we went private. Oh, this is just, they're going to cut everything out. The company's not going to grow. There's not going to be any investment. The visibility that we have as a public company for our customers has helped us in the sales cycle. And then the other thing is, everybody talks about, it's a war for talent out there, and having, a public currency to be able to attract and retain the best and the brightest to help us in this mission. Being a public company has really been helpful. Our accept rates have gone up since we've been able to add that into the mix. So a couple reasons there, but see a lot of potential upside. And Thoma's still a major investor in the company.
Stock as currency is, I think, huge. I mean, you're not the first person to say that, obviously, but like that's like a well-known benefit of being public. So
and if you're going to do that process, doing it with Orlando Bravo and the guys over there, not a bad team to be with.
No, they're awesome. They're a great partner. Yeah, love working with them.
Steve Daly, CEO of Instructure.
All right, thanks
a lot
guys
for coming on today, Steve.
Thank you for coming on.
Awesome.
All right, I gotta say, Aaron, there are a couple of reasons why I should, in theory, not like that stock, and yet I like it.
What do you mean? What are your reasons in theory why you wouldn't like it?
Okay, so I have like broad
because it's a COVID play.
So like in theory, these are broad-based rules because I've been burned in the past. Companies that go private and then go public again, generally speaking, in my experience, have been underperformers. I got burned hard on Kraft Heinz, but you can look at
Krispy Kreme's doing all right.
Is it? I haven't looked.
I honestly don't know. We'll check in. It was doing okay, but that's
okay. So that's one reason. Generally speaking, I don't love companies that go private and then go public again. That's one. Number two is we talked about the COVID tailwind, right? Every company that got a COVID tailwind has come so far off its highs. Now this is the exception, right? And nothing like price to change sentiment, right? So the price, like the chart, I think speaks for itself. I mean, it's education.
So
it's
what are your reasons? So is that your reason for saying that even though you have those other reasons why you would usually be turned off by it, you're not just because it's holding up better than other COVID plays?
Kinda, because it's so sticky. It's like and to Steve's point about the paradigm changing. Yeah, I mean, for sure, it's changed. It's changed forever.
Well, that's what I was curious about with because in my personal experience, and again, this is anecdotal, not any metadata, but we switched over from Blackboard to Canvas, and this was well before COVID. So in my head, it's like, okay, maybe Canvas was growing pretty substantially before COVID, and then it was just and there were other companies too. I mean, I'm sure Zoom was growing before COVID and just got that growth propelled. And then I think going forward, it'll be really interesting to see if Thoma Bravo, how they handle their holding, because they still hold I want to say a majority of the shares of Instructure. So
I'm interested. I'm interested here. I'm not going to go and buy the stock today, but frankly, I never heard of the stock before yesterday. Okay. So I'm going to put this one on my watch list. That can't be true
because I brought it up on the show. But anyway.
All right, you're right. Fine. That was a lie.
I got some wrong. I said to Steve that they had only been public for a couple months. It looks like they've been public for almost 6 months now. So
this is going on the watch list. Okay. Now, would I be saying that if the stock was at $10? Probably not. But the fact that it's held up like it has, I think that speaks for itself. There is no mercy out there for any techie play, and yet here we are in INST. Granted, it's got a very low beta. It's good trade with a range between 18 and 30 for 6 months. So
that's what I think is interesting. That's
move a lot.
What I'm going to be really curious about with this stock is looking at what Thoma Bravo does with its shares. Because if it trims a little bit of its position after it takes it public, okay, that's no big deal. If it sells half of its shares or something, then I'm gonna be like, okay, there must not be a lot of conviction there. But if I see Thoma holding most of these shares, then I like this long term because look, education, COVID or not, education was already changing. Like e-learning is becoming a thing. Are there upsides to it and downsides to it like anything else? Of course. The downsides of kids having to go remote learning throughout COVID, they're well documented, and there's gonna be more and more data coming out about it. But at the end of the day, are there upsides to having more access to educate, at Canvas and having the integration of hybrid classes, being able to do some things online? Of course. So I think COVID aside, the space is it's a growing space, and this seems to be a leader, if not the leader, in a growing space. So I'm with you, Spencer. It's not a stock that I own right now. It's on the watch list. Again, something I'll be watching for.
This is going on the watch list for sure. And again, on paper, in theory, it's like, well, it's a COVID play. You don't want to own any COVID plays right now, but this seems to be the exception. I mean, how many IPOs in the last year look like this? Like one or two of them, frankly.
Well, to your point, Spencer, about this holding up than a lot of other quote unquote COVID plays, I would say this stock wasn't public when all these other stocks got that run up. So who's to say?
Maybe
if this stock
that's
wasn't-
why.
Right. If
why.
this stock was public 2 years ago, then it ran all the way up to 150, then it'd be getting beaten up right now. But because it never was in that environment, that it
I'm
did
interested.
get that incredible run up, that now we're kind of steady. Plus, I'm pretty sure yesterday was either the first or second earnings report from the company. So it's fair to say that maybe people are just kind of hanging out or until
I'm
we get some
interested.
more clarity on the financials of the company.
Yeah. All right, INST, it's on my watch list. Let's bring on Tim Quast. Maybe we can ask Tim what the market structure looks like on that. Although I don't know if he'll have the data.
It's a
'cause
low,
it's
low.
only been public
low-
for
low
6
beta.
months, so may not be. But Tim Quast is the founder of Market Structure Edge, joining us here on this special day because it's an options expiration Friday, and let's see what Tim thinks about all this because we got Ukraine and Russia doing stuff, and the market in limbo, and what does the supply and demand say about all that? Tim, what's up, man? How we doing?
Good to see you. Happy Friday, guys. AB, Spencer.
Oh, wait a minute. You guys are near each other right now.
Oh, are you in Steamboat, Tim?
Yeah, I thought you had that mountain home look behind you.
I am in Breckenridge right now. Let me see if I can give you a more. We've got a nice little mountain lodge.
Oh, that's good, good, good. Yeah. Same here, except this is
You might have moved to a bad.
No,
Yeah, is
he's
that
good.
okay?
He's good.
There we go.
He's back now. He's
There we go.
back now.
Yeah.
right.
Well, alas, Summit County and Routt County are quite a long way apart. We talked
oops.
last week
Sorry.
about trying to catch each other, and we're more than 2 hours apart. Believe it or not,
All
AB.
right. My Colorado geography needs work, I guess. Apologies there.
Well,
all right, Brian Blockchain. Brian,
go grab a beer, right?
Yeah.
We would do it if we could. Yeah.
Well, if we both drove toward each other, like maybe I don't know what the middle would be, Silverthorne or Dillon or something.
Kremling. You'd have to go to Kremling.
We could be having
Kremling.
a beer. We could be having a beer in an hour and 15 minutes from now, Tim.
Roughly, we could.
Roughly.
Is it snowing there?
It is not right now. Doesn't look
Okay.
like it. There's a lot of snow out there, though. Don't get me wrong. There's
Yeah.
a lot of snow out there, but
That's
it's
good.
not currently snowing.
It's snowing here. It's snowing on the mountain and on the road. So it would be an hour and 30 for me, just a little bit longer.
Oh, because you
All right,
have to go more up. than
Right.
down?
The conditions are a little more challenging here.
Oh, okay.
Yeah. And you're right. I would have to go up and over because we're actually a lot lower than you are. So Breckenridge is, call it 9,000 feet, and Steamboat is 7. But you have to go up to 11 and back down to 9. That's the geography.
By the
Much
way, if
like
anyone's curious,
that's
if anyone's curious, we are not going to talk about stocks or market structure today. We are only going to
Weather.
talk about Colorado geography
Talk about the weather.
and topography.
Well, it's an app. It is an app descriptor for the stock market. The stock market is nothing more than topography. That's what it is.
wow, what a segue.
What
All
a
right, Tim.
segue.
So, Spencer, I didn't answer your question. Alas, we do not have INST.
Yeah, I figured.
The thing that, so particularly if there's an element of the unusual related to how they rejoin the public markets. But I sent a note while we were talking to the team to add that to the
Okay.
database because we could do it.
Cool.
So Monday we could look at that, Spencer, if you or I remember, and we'll have a look and we can tell people what market structure indicates.
We can do that.
Okay, good. So
Yeah, what I was going to say was Brian Blockchain said that Tim is one of my favorite regulars. So good to have you on, Tim. Well,
Thank
let's
you.
start broad
Appreciate
here,
that.
and then
Thank you.
let's start broad, and we'll get specific then. But
Okay.
From your perspective, I mean, from my perspective, we are at the mercy of the headlines. But from your perspective,
Well, headlines affect arbitrageurs. Headlines don't affect investors. Investors aren't looking at the futures, the continuous stream of headlines that say, oh, Russia's oh no, it's not no, they're massing. Oh, they're not. Yeah. Oh, that's not what's happening. The people who will profit from that are principally machine reading algorithms that will exploit slight price differences, which is, what's the definition of arbitrage? buying and selling the same thing at different prices. That's the definition of arbitrage. So when everybody talks about the markets being influenced by these things, what they're really talking about is speculation. The entire the pantheon of punditry is obsessed with telling us about arbitrage, which on its face is cognitively dissonant. If we're supposed to be focused on the fundamentals of investment, then why would we talk about that stuff all the time? So that is not the reason. It certainly has an effect. There's no question that the market can be influenced by headlines, because 53% of market volume comes from machines with automated algorithms. They're going to react to that stuff. Only 10% of market volume traces back wholly to rational thought. And so, yes, that will be a factor. But it's not because suddenly we all changed our investment posture because we're concerned about Ukraine. Frankly, I'm sorry, but at risk of saying something Chamath Palihapitiya-esque, I'm going to say, who cares about Ukraine? Of what difference does Ukraine make to anything that matters to us? Zero. It does not matter. So the only reason it dominates the headlines is it's politically expedient to talk about it. So now let's get to what's really going on. What really happens? And you touched on it, Spencer. During options expirations, there are black holes that develop in the marketplace. That is, there are places where light disappears. It's very difficult to understand how at risk the market is to resets to the value of derivatives. So all we can do as traders, pay attention to this, is to understand going into options expirations what the risk might be. You know, one of my favorite sayings, those of you who have heard me for a long time, I say the prudent foresee evil and hide themselves. So if all of the demand lines are flagging and all the supply lines are rising and broad sentiment has peaked and is falling into options expirations, what would a wise person do? They would avoid it. And it wouldn't matter what Ukraine is doing or what the Fed does. What matters is supply and demand. And I want to, stop me there. Yes, go ahead, Spencer.
I mean, I was going to say that all sounds good, but I mean, I see it happen every morning. A headline hits and the market reacts to it. So it's
machine reading algorithms.
Sure,
Realize that over 95% of trades execute on algorithms. The US stock market is 100% electronic and 95% algorithmic. And those machines are positioned right next to the servers that spit information out. So I'm going to immediately consume that information and change my posture in equities and options. That's what I'm going to do. It's really interesting to watch the long short fluctuations, by the way, Spencer. And it really shows up in cryptocurrencies. If you like, I'll show you something. Here, let me show you something.
Yeah. And then we can move on from this conversation about what is moving the market, and more so get into how to trade it regardless of the
because there are good things to trade. We can look at DOCS, Doximity. I pointed this out in the market desk note today. If you look at supply and demand, and I used a term, I tweeted a term, and I'm going to talk about that and what it means to trading here in a moment. But let's go look at cryptocurrencies. So I have a cryptocurrency stocks portfolio. So here's the interesting thing. There are 7 components in it. So I'm going to know when. So if demand begins to surge in that group and supply begins to wane, that's when I'm going to trade it. I'm not going to buy those things when demand is below 5. But look at this chart down here. This chart, for those who don't know Market Structure Edge, is a treatment of short volume. So short volume is the supply chain of the stock market. It is the amount of trading volume on a percentage basis for a stock or a group or the broad market coming from borrowed stock. So notice that almost 50% of the volume in the cryptocurrency group, if you can see my screen, is coming from borrowed stock. But here's the interesting thing. Since January options expirations, this has been highly unstable. That's very unusual. So what that tells us is that there's a lot of algorithmic trading long and short in this group, and it's constantly changing. Almost every other day, it's changing. And so that's going to create a lot of instability. Now, on the demand side, traders, you're going to know, is there rising demand? Yes, yes. Oh, peaked, begins to decline. That's when you leave. Do you want to, it's, which gets to this term that I want to share with you, traders. There's a legal term called ceteris paribus. What it means is all other things being equal. And it means, so what we're doing is a qualifier. We're qualifying that all other things being equal, what determines the value of something? Anyone? What determines the value of something? It's not a trick question.
The price someone's willing to pay for it.
Exactly, AB.
Oh,
What someone is willing to pay. So all this discussion, Amazon, there's 30% more value in Amazon. Well, not if someone's not willing to pay that. A stock can go down 40%. The stock's way down.
You make it sound so simple, though, Tim.
It is simple. It is very, very simple. Things are worth what someone is willing to pay. And understanding what someone is willing to pay is evident in supply and demand. And the stock market is the only market we don't measure in those terms. We assign some kind of multiple to values. Well, in the housing market, we look at housing starts and housing sales with supply and demand. In every other market, we look at supply and demand because it's the elementary way to understand prices. Since the beginning of time, since before the wheel, we have understood that prices lie at the nexus of supply and demand. And to the degree that they separate, prices rise. To the degree that they converge, prices fall. Not complicated, right? So all this discussion about Ukraine and the Fed and on it goes is confusing busy with productive. Let me show you. All right. So Spencer, we talked about this on Monday. So if you wanted to own something that was going to do the opposite of the market this week, how about
this has been a tremendous one this week, Tim. I've been watching it.
Right. And now it might be time, we get to the end of options expert. I still think it could go higher. I think this supply demand divergence, even though it's been up and down today, says demand continues to rise. It's hit 10 and supply is still falling. All other things being equal, ceteris paribus, that stock could still be higher. That's what you want to find. You want to trade things that look different than a falling market. So the reason we pointed out DOX today, why DOX? Well, I ran a screen for this. It's very easy here because in any condition, no matter what is occurring, no matter how much politics or monetary policy are attempting to influence the market, there is always a supply-demand opportunity. And so if you look at DOX, why would we say, look at how DOX has done today? Look at that massive separation between demand, this is price, and we're not precise about it because we don't care about precision with price. Price is capricious, price fools you. Demand and supply are what matter. Demand is very strong and supply plunged right into options expiration. So that tells me people are having to cover calls. So the stock's up 2% or more today. Well, you can know that that's coming. And that's what you want to trade instead of wringing your hands over what Ukraine is doing. And I'll give you one more. So I ran a screen today for stocks that have spent 20 or more of the last 30 days at 5.0 demand or better with short volume. The supply side, 48% or lower and trending down. That's below the S&P 500. And that trade $10,000 at a time. Very, very liquid. It only gave me 5 names. One of those is NVS. Novartis. So here's the interesting thing about Novartis. It's right at 5. It spent a lot of time at 5. You don't want to own it when it's below 5. Above 5, it does just fine. But look at this supply deficit. That suggests that come Tuesday, because of the holiday, there could be significant demand for new call options in Novartis. I'm not saying it'll happen, but that's a very good indication of something that you want to own. It's a supply-demand divergence. If they converge, leave, because that's telling you that the price will now begin to deteriorate. Once again, back to very basic principles. Prices lie at the nexus of supply and demand. And when demand rises greater than supply, price increases. When they converge, price declines. It's not absolute, but it's a very good principle.
Tim, someone in the chat asked a few minutes ago before you came on about Roku, and I have my own thoughts, but I would be curious to see what your data says about Roku. I'm going to take a wild guess here.
Okay.
And say demand is falling off a cliff.
Okay, let's see.
Huh.
It's actually not. So
That's
demand
interesting.
hasn't fallen off the cliff, but the problem is the supply side. So it tells you the convergence of the two. Clearly, Roku has spent a lot of time in the cellar. It was a 1, a 1, a 1, a 1, a 1. Then into February, the beginning of February, new month, new money. That's when new money shows up at the beginning of the new month. People are making monthly contributions.
Wait. Can you?
Yep.
Oh. Okay. I see.
Yep.
I see.
So
Okay.
see at the beginning of February, so traders, listen to this very carefully. If you're tracking Roku and it ticks up from 1, and then you look down at the supply side and the supply side's moving the opposite direction, there's your opportunity to trade. And it doesn't matter what price Roku is currently at or how someone on Wall Street on the sell side or the buy side is valuing Roku. Oh, Roku is very discounted. Well, that's irrelevant. What only thing that matters is supply and demand. Well, there was your opportunity. But notice the trend line on the supply side. Up, over trend. So the only reason that Roku is down is because supply is more than 60% of the trading volume is coming from borrowed stock or manufactured stock coming from market makers. So even though the demand side is pretty good, that has destroyed price.
This still breaks my brain. We've talked about this before, Tim, but like when the term for what you just said, where a trading supply comes from borrowed stock, I think the term for that is rehypothecation, right?
Well, that's a complicated term that means that stock that has been borrowed is lent again. So this is different from
fine.
This
Sorry,
is very
that's
different, and it's very
different.
simple. I want to make sure that people understand that there's nothing nefarious about this. This is not naked shorting. It gets to the entire purpose of the stock market. If you're going to beat the market, you have to first understand it. And one of the core principles, and I know you want me to shut up on this, but I think this is very important.
I don't. This is important. I don't want you to shut up.
I think it is that you. So listen to this very carefully, traders. What is the purpose of the stock market? You would say, well, it's to form capital. It's to match enterprising businesses that have growth prospects with risk-taking investors. Oh, would that it were. No, the purpose of the stock market is to foster a continuous auction. Yeah, well, you hope so. I mean, we want to get rich on it, but if we're going to get rich on it, you have to first understand its purpose. Its purpose is to make sure there's 100 shares of everything at the bid and the offer, not more than that much. The trade size in the S&P 500 now is 102 shares. That's it. That's the average trade size.
That's the average
once
trade
you understand,
size.
Yes.
Yeah.
So once you understand that all that matters is 100 shares on the bid and the offer, then who cares? Once you understand that that's the purpose, what will cause prices to change is the degree to which those conditions exist. And it cannot exist. There cannot be a constant 100 shares of everything for sale unless the SEC permits market makers to create stock. And that is the supply side. It's not borrowing in the conventional sense. It is that the SEC says that Goldman Sachs, thou shalt, in all the stocks that you make a market in, make sure that you have 100 at the bid and 100 at the offer. And Goldman Sachs says there's no way we can be sure of that. So unless you exempt us from that rule, the short locate rule, we can't do it. And the SEC said, fine. So we always know when those conditions exist. Right?
Wait, why does that have to? So if 100 shares is the average trade size in the S&P, frankly, what does that have to do with every other stock out there?
I'm not sure I understand your question.
If the average trade size in the are you referring to like the S&P 500 index?
Yes, the 500 components. The 500 components of the S&P 500 average 102 shares. Of course, Amazon averages 18 shares.
You're not referring to like I thought you were referring to the SPY. You're not referring to the SPY. You're referring to the aggregate average of all the stocks in the S&P 500 is 100 shares per trade.
Exactly. Which notice is the regulatory, very near the regulatory minimum bid and offer. And what then does that tell you? It tells you that almost half of all trades are less than 100 shares. So what do I do with an algorithm? I do it as a trader myself. I very rarely buy stocks in increments of greater than 100 shares because that liquidity won't be there. Now I know I've exceeded the requirement. So most of the time I trade in 95 share increments at unusual prices. I behave just like an algorithm. Now why? Because somebody else has to execute that trade by law if it's a marketable trade. if it's a limit order within the bid and the offer or a market order. These are things every trader should understand. You can't trade the market without understanding what's going on in there, right? That's the beginning point. So once you understand that my 95 share trade in Roku at the market has to be taken by either my own broker or someone else, now I'm at an advantage.
But Tim, what are the consequences of broker dealers being able to get around basically create shares out of thin air? I mean, there are consequences to that.
Meme stocks are a consequence of that. How did GME go up 1,000%? Well, because market makers kept creating more and more and more and more stock. Well, at some point, it's got to mean revert. All this stuff that you were talking about earlier, about some of these, the great COVID trade and how these stocks soared and then mean reverted. It is a consequence not of people misunderstanding the value of things, but of market structure. If you manufacture artificial supply to meet excess demand, and then that demand stops, all of those things are going to have to mean revert. It may happen instantly, and it may happen over months, but it will happen.
That's what I think is so interesting about this idea and concept, is that it actually does offer a better explanation, at least to me personally, of like what has gone on with these meme stocks, what has gone on with Tesla, and there will be some people who are maybe Tesla bulls who would say, oh no, if you look at this number and this number, this is what the stock price is justified. But at the end of the day, it's like what you said, it's just a price of what someone is willing to pay for that given name, for that equity on the stock market. But my question is then,
exactly,
does is it fair to say in your mind, Tim, that the fundamentals or some of the more traditional metrics that people look at when looking at stocks, then that plays into the supply and demand?
Well, it's a factor. It's an
It's
input.
a factor.
It's an input. In the same way that the economists measure total factor productivity, where there are 8 different factors that determine productivity, there are multiple factors that determine the value of a stock. Ultimately, it all converges into what someone is willing to pay, but their motivation will be different. My motivation
and how you get there, right?
Exactly. So if I believe Roku it has a third of its value that it could have 5 years from now, then I'm looking at fundamental factors and I'm trying to estimate what its growth prospects are, its ability to improve its margins, its ability to remain at a competitively superior position. But if I'm Citadel, all I care is what was the price a fraction of a second ago when I bought it, and should I sell it now or short it? Those are both equal motivations in the market under law, because under Reg NMS, no market may give preference to one kind of motivation over another. So somebody who is speculative has as much right to set the price as somebody who is fundamental. The problem for fundamental investors is they're 9% of trading volume. 91% of trading volume comes from a different derivation. It may be part of that. So again, you just have to know that that's the case. And so what it does is it tells you that the most profitable behavior is short-term. And then how would we prove that? Well, you look around for evidence. Citadel, Renaissance Technologies, they're very short-term participants, and they make more money than everyone else put together. So there's something to that.
Right, and that's what going back to the fundamental. I mean, because you'll see fundamental investors say, "Oh, say Facebook stock right now is 20% undervalued, so we're targeting a 20% upside on the stock." And it's like, only if people are willing to pay that 20% upside are you going to get that 20% increase in the stock price.
Exactly. And if 9 out of 10 participants in the market do not think that way, then this is what you will get. Look at Facebook's deplorable market structure. You could say, well, Facebook's come down, whatever it is now, at 50%. It's come down, 40% in value. So it's got to be a good value. Well, no, not. Again, back to your point, AB, the correct answer. What is somebody willing to pay? And what's the supply-demand equation? Put those two things together, and you shouldn't touch Facebook with a 10-foot pole right now. When those conditions change, and they will, they absolutely will. We will get to a point where indexes have to rebalance, and they're going to go look around and say, well, I need some cheap stuff. And they won't care what Facebook's prospects are. They just want a cheap product to fill their index and meet their component requirements. At that point, trade it, and you will see it in the demand.
All right, so, Tim. I mean, we love having you on, but every time we have you, I talk to you, I feel like I need like a nap after because it's like so much to wrap my head around.
Well, I hope we can get back to, just remember supply and demand.
Well,
Wait. No, go ahead, Aaron, because I want to ask him something also.
Well, I was just gonna say, Born to Be Free said, "Damn, Tim, I feel like I've been to school every time you come on." I don't know, maybe it's just
unfortunately people hate school. Born to Be Free.
Maybe it's just because I'm in closer proximity right now to you, Tim, than I usually am. But I feel like today's session was especially informative.
Good.
Wait. I want to ask Tim about failures to deliver. Yeah, we've talked about this previously, Tim.
Yes, we have.
How
securities.
Yeah. How often is that happening? How big a deal is that?
It's public information. Anyone.
I know. Everyone probably. I mean, they publish it like they publish short interest. It's not real time, but you get it eventually.
And 80% of them are ETFs, which are ETFs take this whole concept to a different level, and we won't bog down in that. It's not a factor, Spencer. Failures to deliver are not a factor in the way that the market functions. Neither is shorting, in the sense that the Department of Justice now has launched an inquiry into short selling practices, which I find amusing because the Dodd-Frank legislation from 2008 includes a requirement for monthly short reporting. The problem is Congress did not specify a time frame. And so because of that, the SEC has not regulated to that legislative requirement.
Wait, that monthly FINRA reporting that wasn't around before the recession? Is that what you just said?
It hasn't been implemented. So it is the equivalent of a 13F. So a 13F comes from the Securities Act Section 13F, which is a quarterly filing by institutions with 100 million or more of assets under management that are 40 Act companies. 40. Right. So then they are required to publish that data 45 days after the end of the quarter.
Right. But the FINRA, the monthly FINRA reports, no, they're bi-monthly. It's every 2 weeks, right? So that's
short interest. That's short interest.
Oh,
that's short interest is not regulated by either FINRA or the SEC. It is a Federal Reserve requirement under Regulation T, and that was created in 1974, and it has not changed since. And it's all the same as useless. It does not tell you anything about the market's form or function. So that's why we measure short volume. Short volume is a 2009 FINRA regulated requirement for brokers under SEC Reg SHO. So that is a reliable figure that tells you about supply demand fluctuations. Here's my point, Spencer.
Yeah.
Dodd-Frank required people like, pick your, Carson Block, Muddy Waters, short sellers to report their monthly short positions. But the SEC has not implemented that requirement because Congress put no time frame on it. And because the lobby from SIFMA and other very, very powerful financial interests is so great, no one's furnishing that information. But here's the kicker. Barely 1% of short volume is active short selling from the standpoint that I'm deliberately targeting a company. Maybe 10% of it is coming from long short hedge funds. And then the rest is market makers just manufacturing it.
Okay, the reason I brought this up in the first place, and I don't want to get too deep into the weeds here, but the FTD, the failure to deliver concept, has sort of got it. The idea of that has really gotten legs in the last year, as it pertains to AMC and GameStop specifically.
Yep.
To your point of view, from your point of view, is that a factor in the daily movement of those stocks?
No. How often did they show up on the FTD lists?
They're on there, but it's not. I mean, I haven't looked in months. I'll be honest with you, Tim. I haven't looked in a while.
If they showed up 2 times, I would be surprised. And it's a tiny little bit. That's not the problem. If you go read, again, traders, you can go do this. Go Google SEC GameStop report. It's a 45-page document. They do a very good job.
I read that.
Yeah, they do a very good job of explaining market structure, and that there are they explain it, that they just speak in regulatory speak. It's difficult language, but the problem is market making. But they're stuck between Scylla and Charybdis, rock and a hard place. They want a continuous auction. And the only way to prevent a GameStop situation is to remove that ability for market makers to manufacture stock. The trouble is, intraday volatility would explode to 20%. Stocks would be moving like crazy. You wouldn't be able, you try to sell something and go down 20%. No one would take the other side of a trade. So which is it? So they've chosen meme stocks over a market that really reflects supply and demand.
Something I'm curious about right now is volume, because I see, and I know a lot of times we have a couple of technical traders that come on the show that like to look at the volume bars to see, whatever. But like I just saw a tweet saying 50 million shares of Roku traded so far today, average daily volume less than 6 million. But if you look at Roku's chart, it's been pretty flat and down 25% all day. So like what is the impact of knowing that 50 million, that the average volume is traded way higher today than a typical day?
Right. It's a great question, and it's the classic question. I'll go back to a very basic idea of the difference between volume and liquidity, which I had explained to me by a good friend Joe Saluzzi. You know Joe Saluzzi.
Oh,
and
yeah.
So it was a decade ago, and he said to me, Tim, if I have a beer and I hand it to you, and you hand it back to me, which I would be unlikely to do, by the way. And then I hand it back to you. What is the volume and what's the liquidity? And he said the volume is 4. The 4 beers have traded hands, but the liquidity is 1. There's only 1 beer. IEX published some beautiful data about what happens to the quote and volumes when there is a change in information. That information can be earnings, it could be options expirations, and they track the data from full service broker dealers. So that would be a Goldman Sachs, Morgan Stanley, et cetera. Full service means they provide the full suite of brokerage services. There's a tiny little bit. Agency brokers, so this would be like the old ECNs. Instinet is an agency broker owned by Nomura, where they don't commit capital. It's a platform that you can match on. Citadel operates an agency brokerage. Themis Trading, Joe's firm, is an agency brokerage. Yeah. They're not committing their capital. There's a little more increase in it. Then there are proprietary traders like Hudson River Trading, Quant Lab, Infinium, GTS, the Tower Research, Two Sigma and there is a colossal, like 20-factor explosion in the amount of activity around any change to the bid and the offer caused by these firms, which don't own anything at the end of the day. So there's your answer, AB. When you see explosions of volume, most of the time, the likelihood that involves large institutional movement is a number approaching 0. And we've long known this. We tell people you can't use volume as a measure. You have a terrible prime broker if your prime broker causes a movement in volume. Your prime broker should melt your orders right into the order flow. Otherwise, they're being picked off. So when you see those explode, there's a clear reason for it today.
That's why you see these huge volume spikes at the close and the price barely budged.
Yeah, of course, remember, everybody's trying to get the reference price too. So then machines get in the middle of that, and everybody wants the average price because they need that. Yeah. If you are running a mutual fund, the only price you can give to your fiduciary clients is the reference price, the last price. Yeah, exactly.
Wait, Tim, I'm sorry. I have one more question, then we'll let you hop because we can do this all day. But I have a question that I've asked several people, and I've stumped them all. I keep forgetting to ask Dennis, and I'm going to ask you now before I forget. So I want to bring up this chart here. Okay, this is BDSI. It's a small biotech. It got acquired last week. Okay, got acquired for $5.60 a share. So my question for you is: the day the acquisition was announced, it was February 14th. I guess that was Monday. 61 million shares traded on Monday.
Okay,
I understand.
I have that.
I understand who the sellers are. Who is buying BDSI on Monday after the news of the deal is announced?
The short answer is what we call fast traders. That is a classic example of the two things we've just spent all this time talking about, which is the market maker exemption from short locate rules and the ability of machines to explode the volume and not have to worry about where the supply is coming from. So that is all arbitrage, and it's related to derivatives. So this is an effort to create an arbitrage spread between BDSI and, say, biotech futures contract and options on a futures contract or a basket of options, and to profit on that. But remember, a high-frequency trader wants a half penny. That's it. So if I could trade 60 million shares and I make a half penny, wow, what a day. And there's nothing stopping them from doing it.
All right, so
all
that
the time in my own
that was my theory. Was all these people, if you zoom way out here, right on this chart, all these people to the left that have owned this stock all this time, they're selling. Their stock's going off the board regardless. They're selling regardless. But on Monday specifically, they're selling to just an endless series of machines that are trading with each other. That was my. Okay. Now we know. Now I feel better about it.
And that stuff won't cash settle. It will. The liquidity coming from high frequency traders will commence on the same day that it's returned to the custodian. The tiny little bit of it that existed out there. So I could go borrow 100 shares and trade it 1 million times and create 100 million shares of volume, but it's still only 100 shares. Still just one beer. That's what happens.
All right. Tim Quast, if you want more from Tim, I highly recommend you check out his site, marketstructureedge.com. He puts out his note there, his research is there, his data is there. Can't recommend that enough. Tim, we'll talk to you again on Monday on Pre-Market Prep.
Have a great 3-day weekend, guys.
No show Monday.
Right.
Shit.
No market structure Monday.
No market structure Monday.
We'll talk to you in a couple weeks, Tim.
Okay.
Talk to you in a couple weeks. All right. Damn, I forgot about that holiday. All right, we'll talk to Tim in 2 weeks. That was a fantastic conversation. The problem is with Tim is I always feel like I never got to the bottom of what I wanted to know, because we always end up going down different rabbit holes. And then my brain is exhausted now, Aaron, because I'm so like deep in thought down these rabbit holes of market structure that I feel like I need a break after. But so here's the deal for the rest of today's show.
We're going to end early.
We were supposed to have a guest, but I did not confirm with her until very late in this process. So I think we're going to bump her to next week. And there is no Moon or Bust today, because the Moon or Bust guys, Logan and Ryan, are also in Colorado. They're in Denver, which, as I understand it, is very close to Breckenridge, based on my geography knowledge of Colorado, and the Rocky Mountains.
Hour and a half drive.
Okay, sure. They're at East Denver right now. They're going to be doing a stream later on in the day, probably at like 6 p.m. Eastern time. I basically told them, I was like, we need content from you. We need posts. We need content from you. So there's no Moon or Bust show today at 2:00, but they are going to be doing a stream, I think, later on in the day. I'm not going to tease who, because I think they had to get permission to do it first from the conference.
So we'll probably go for another 5 minutes here. If anyone's got any questions, any things they want us to look at in the chat, let us know. But Spencer, going back to Tim real quick, like you said, like your brain hurts from it. And the conversation, they oftentimes get in like the nitty gritty, but I like the idea or that concept of supply and demand being the ultimate driver, because it's a better explanation for me for why Tesla's $850 a share, when you look at the financials compared to Ford or GM or any of these legacy automakers, is it's not about fundamentals or growth or anything. It's just about what is someone willing to pay for the name Tesla on a stock certificate. Which
I forgot to mention to Tim. Tim would love the Beanie Mania documentary on HBO. I finished it last night. Tim would love that. I'll send him a note after.
Okay. Lady Fortuna wants us to recap Roku, please.
Okay. Yeah, that's good. We can do that.
This is what happens when a growth stock stops growing.
So okay, what Tim said on Roku. Remember, all of Tim's analysis is dependent on two things: supply and demand. Tim said, and he looks at supply as it pertains to, and it's both of those numbers are quantified by his proprietary data, and he's looking at the participants in the market and where the trades are coming from, like i.e. how trades are getting through the market pipes. Are they coming from a broker dealer? Are they coming from a high frequency trader? And what that infers about where they're coming from. So Tim looked at Roku for us, and what Tim said was, okay, demand is not dropping, the supply is rising, and so you get rising supply. Typically means from his point of view, a lower price. From a market structure perspective, there is more more supply of Roku shares out there, and this is not because the float is increasing, because it's not. The float's staying the same. It has to do with the broker dealers, and the prime brokers of the world creating synthetic shares as it pertains to the whole conversation we just had.
Yeah.
So from Tim's point of view, the supply of Roku shares are rising. That's not a great sign. From a normal person's point of view, the chart kind of speaks for itself. Okay, the earnings were out yesterday, and they were pretty terrible, Aaron. Go.
Well, so what I wanted to talk about was from more of a, and this will be a nice segue in, because we do have to mention, again, we're going to wrap here in about 5 minutes, but we do got to mention Cathie Wood too, and Roku being one of the top holdings. But from a long-term perspective, like if you're looking to get into Roku, what I would say is, like, I like the company long-term, right? Like, you go buy a smart TV right now, they all come with Roku. Or if they don't, then people go out and buy the Roku. Like, Roku is huge. I think it's going to continue to be huge. But I wait to see, like, growth is getting hit all around right now, especially a stock like Roku that had the COVID tailwinds at one point that has now seen that growth slowed. It's back to pre-COVID numbers. I mean, the chart's actually, this chart is beautiful, Spencer, how symmetrical it is on that peak, right? And we're now at pre-COVID levels. I just wait till you see that strength coming back in, right? We were just talking about supply and demand. You'll be able to see, even without market structure edge, when demand starts to increase, you'll be able to see it in the chart, then start a long position in there. Because could this continue dropping down to $90 a share? Sure. Could it reverse on Tuesday? Sure. But I'd rather wait till that reversal comes in and we have that confirmation than trying to time it.
If you are interested in Roku for a long-term position, and when I say long-term, I mean I'm talking at a minimum a couple of years. I'm talking like 2 to 3 years at a minimum. That to me is a long-term. That's what I qualify as a long-term position. A couple of years minimum. If you're interested in Roku for a long-term position, then there are worse times to buy it than now. This is not the worst time to buy it, because 2 to 3 years from now, are you really gonna care whether you got the stock for 106 or whether you got it for 100 or 95 or 90 or 110 or 115? Probably not. And also, as a prudent long-term investing strategy, you can scale into things. You don't have to buy your entire position.
Well, that's what I was going to say. If I had an envelope of cash that I wanted to buy Roku with, like the envelope just says Roku on it, it's got $1,000 of cash in it, I'd start deploying that position today. I wouldn't put all $1,000 in it. I'd maybe buy $200 worth of Roku, 20%, and then just build that position over time. Because like we said, it could continue to drop, or you get that confirmation, and then you have more conviction. So you double down. But those are the thoughts on Roku and Spencer.
Well, wait. I have more thoughts though. But you
Cathie Wood.
Yeah, but okay, fine. I'm willing to stay past 130, so I'm going to do that because I have more things to say.
All right, fine. Let's keep going on Roku real quick. Okay,
but my thought is, for a long-term thing, if you want to start building a position, fine, right? Like let's say your goal is to own 100 shares, or your goal is to own 50 shares. You want to buy, 5 now, 10 now for the long term, fine. If it were me, and I wanted this thing for a short-term thing, there is zero chance I'd buy it today. I think if you buy Roku today, you need to operate under the assumption that in the near term, you're going to lose money. Okay? You are going to lose money in the near term if you buy Roku right now. If you're okay with that, then fine. Right? Again, if you're okay, if you're going to hold Roku for 10 years, then do you really care about the next couple of weeks or couple of months, right? Or a year? No, probably not, right? But you're going to lose money if you buy this stock today in the near term. You just are. Yes, great comment in the chat. The PayPal chart, the Square chart, Roku, they all look the same. Yeah. They're all the same. They're going to go. They've been going down, and they're probably going to keep going down. Frankly, that's just reality. Whenever you get a big gap down like Roku has today, what I always say is just wait for the dust to settle. Like look at look at Shopify. Okay, Shopify is on my shopping list, pun intended. Great company, great business. Okay, look at their earnings gap. They had earnings on, what was it, Tuesday? I think it was Wednesday, Tuesday or Wednesday. I forget which. It doesn't matter. Okay, and they gapped down on their report. Okay, their growth is slowing. They gapped down. They dropped in one day. They went from 843 to a low of 720, and it closed at some. So it fell $100 in one day. Okay, that was 2 days ago. We've fallen another $100 in the next 2 days. Okay, there is more. Very often, never say always, but very often more pain ahead when you get these huge gap downs. Wait for the dust to settle. If you're going to buy Roku, you need to accept the fact, like if you're going to buy it today, accept the fact that you will lose money in the next few weeks, few months, who knows how long. If you're okay with that, then fine. But that's where we're at right now. I would definitely not try to buy Roku today if I wanted to make it for
100% agreed.
Okay. On the Cathie Wood trade, on the Cathie Wood thing.
Well,
Yeah. What?
I was going to say, first things first, we got to come to her defense a little bit. And that's on the Zoom thing, right? This went viral on Twitter yesterday, that the Zoom pop-up that said you have 20 minutes left or whatever. And people, basically everyone ran with it saying, oh, Cathie Wood, owns this much of Zoom stock, but she can't pay for it. Okay, well, it turns out it came on the CNBC side. And Cathie Wood, or maybe not her, but the ARK Twitter account put out kind of a snarky tweet about it saying, CNBC's time horizon may be 1 hour, but ours is 5 years. Basically, if you guys missed it, Cathie Wood went on CNBC for an hour-long interview yesterday. It got kind of heated, and she's in the hot seat right now. She went from being a year ago everyone's most beloved investor to being kind of the face for all of this growth sell-off that we've seen over the past month.
My question for you, Aaron, is do you think that interview yesterday, because it's very rare that CNBC gives someone that amount of airtime where they said,
that's why the Zoom thing popped up.
Right. Come on for the entire hour-long show. That almost the only people I can think of where they ever do that, besides if it's like guest host situation, is like
they had Einhorn on the other day for a while, but it was on the phone. So I wonder if they didn't run into the Zoom problem with him, but he was on.
But my question for you is, do you think that interview yesterday will go down as like a tentpole moment that people will remember, almost like how they remember when Bill Ackman and Carl Icahn yelled at each other on CNBC, or they remember when Jim Cramer had the meltdown during the Great Recession? Do you think that interview, when we look back at ARK Invest in 5 years, people are going to look back to that and say oh, that marked the beginning of the end, or that marked the bottom?
Yeah, well, I think it depends on what happens from here, right? I think if we continue to see kind of ARK crash and burn as it's been doing the past couple months, then it will be okay, I remember when she came on. And here's the thing that I think is not kind of ironic. I don't know if I'm going to say funny, but ironic. But she came on yesterday and said, we believe we saw the bottom and it was on January 27th. Well, a day later, we've fallen through that bottom. So she gave Cathie Wood's famous for giving some of these predictions, right? And that's what I would say my biggest criticism of her at this point, because I do think a lot of it's not unwarranted, but a little bit overblown. Because if you look at ARK's returns over the last, well, actually, I haven't checked in a while, but the last time I checked,
they're still. She talked a lot about the returns as it compared to the Nasdaq. Also, right. She admitted this is interesting. She admitted that she didn't even pay close attention to what is in the Nasdaq until recently, which I thought was interesting. But not that she has to. But the return profile, if you go back to inception, is still good because the last 5 years are amazing. But
right, if you look at the 5-year return, it's still great. Yeah. So that's why I think people just have such a short, attention span and memory that you see something down 30% over the last 3 months, and you're like, oh my god. But then if you zoom out, and you're like, oh wow, this has actually been very strong, all things considered. I would say my biggest criticism is I would like to see her, I guess, show a little bit more humility, a little bit more, you know, to say things like that.
Acknowledging that a lot of people, because the flows that into ARK funds, I think hit their peak in December or January 2021, that like about a year ago, right? And so a lot of people are underwater. So an acknowledgement of that, I think, is probably
and just saying like, okay, maybe she should step back from making these like bold claims, like we've seen the bottom, when they don't come true the next day, because then over time you continue to do that, you lose credibility, you lose trust in investors. But my point to your point, Spencer, was I do think if we could, if ARK, the story of ARK is over essentially, then that will be the tentpole moment. Like people will look back at that. If we see ARK, bounce back up, and a year from now we're not having this conversation about ARK being in the dumps, then I think it's kind of like a foregone thing, kind of a forgotten moment in time.
Yeah, I think give her credit. She sticks to her guns even when it's really hard to do that. And her unwillingness to give an inch on her opinions is, if you love her, it makes you love her more, and if you hate her, it makes you hate her more, right? That's just the reality. So,
well, that's just what I wish. And this isn't for Cathie Wood, but I wish for everyone. Like we were. I feel like a lot. We're in this time where things have to be binary. Someone has to be good or bad, right? Like there are things I like about Cathie Wood, and there are things I dislike, and I think that's fine.
Yeah, that's a great point. I have been and will remain. Let me pull it up on the screen. An owner of ARKW. It is a small piece of my portfolio. I do not sweat it. I do not think about it. It's not going to kill me. And actually, I think at this point, let's keep going left here. At this point, let's see. I bought ARKW. All right, I'm still up in it, but I'm up a lot less than I was. But that's neither here nor there, right? If you own things like this, and you own them for the hope that they will go higher, that's not a good reason to own it, right? Hoping is not a good reason.
Sadat says she's only supposed to be 5% of your portfolio.
She's 5% of my portfolio.
Spencer brought that point up yesterday that he thinks that even if you asked her, she would say this shouldn't be, everything you have. ARK shouldn't be your entire portfolio. It should be like a small growth aspect of it. All right, Spencer, I gotta hop. I know you've got a guest joining you here
I do
now.
Yeah, I wasn't sure if she was going to join, but AB, have a great weekend.
You as well.
Don't ski too hard, all right?
I'll see you on Tuesday. Love you all, Zinger Nation. See you guys on Tuesday.
Yeah, actually, Aaron and I are both going skiing this weekend. We'll see who can ski harder. All right, I wasn't actually sure if my next guest was gonna be here because I emailed her very, very late in the process, but she's here, and I'm excited. So let's bring her on the show. Aly Angel. She is just a trader. She's just a regular person, just like me and you, and she trades for a living. And I want to know about her strategies and what she trades and how she does it. And so let's get her on the show. I'm gonna give Aly, because she's a new guest, we'll give her a special guest intro number 2. All right, Aly, welcome to Benzinga Live. How are we doing?
Hey, Spencer, how are you?
Dude, good. I felt terrible because you emailed me yesterday and I didn't respond because it was a whole thing. I'm sorry, but I'm glad you're here anyway.
Me too. Yeah. So I woke up a little bit late. I was working on my guide last night until about 4:00 this morning. And
what?
Yeah. So about, 20 minutes ago, I was checking my email. I'm like, you got to be kidding me. So I'm here. I have,
sorry. I'm sorry. I'm sorry, Aly.
Like, this is me in the raw, so it's awesome. This is how I look on most days. I do have pants on though, so that's a plus. But
I mean, I wouldn't have known otherwise. So,
exactly. That's the greatest thing about trading. No pants.
Yeah. Okay, so let's talk about what kind of trader are you? What do you trade? What are your strategies? How do you do things? And also, if you want, you have the option to share your screen, and we can see your charts, and we can.
I do not have anything set up. I literally.
Okay, that's fine. That's fine.
So I started in 2018, and I, in real life, don't like rules, but in trading, I love rules because you can make them work. You know what these companies are going to do. So my first trades were the reverse split. And back in 2019 when that was hot, awesome. And then 2020.
Wait. When you say the reverse split, what do you mean? What do you mean? You're trading stocks that are doing reverse stock splits?
Yes. It sounds horrible, right? But there's rules around it.
I hope you're shorting them.
No. Okay, so I am a long trader. I tried shorting when I first started, and I get really cynical, and I like to be positive, and I like to have zero anxiety in my life. So I learned very quickly shorting wasn't for me. Long trader, I like to swing trade because I get anxiety when I day trade, that morning panic. And like, who named it that? Seriously. But long trader, and I look for things at lows. And of course, it's the generic buy low, sell high. Well, you have to buy at the lows in order to be a swing trader. You can't just get in and, it's probably going to stay here. Stop losses. I totally spam social media with stop losses save accounts because they do. So I very early on started using stop losses and we just kind of track everything. I love spreadsheets. Spreadsheets are kind of my life. It's a little ridiculous, but they get your ability to create statistics and see what the probability is. So now all these IPOs and the OTC uplifts and currently the D-SPACs, my screens are this way. So that's why I'm pointing over there. But with these, they'll have rules they have to follow. And knowing the rules is really tedious. And there's a lot of FINRA rules, SEC rules, NASDAQ, you know how they are. But if you know them, you can follow them. Or you can know the companies are going to follow them.
So can you maybe explain, like, let's start with the D-SPACs. Like, how do you trade a stock that is D-SPACing?
So I don't trade when they're still a SPAC. So there's a couple different things that go with the SPAC. We've got the redemptions. They can fail. We have ones that, go to 80. I'm never going to trade that. SPACs generally hang out around $10. That's healthy. They de-SPAC, and then they have this process. So we're going to have our redemption values. A lot of them right now for the warrant conversions are at 1150. So that's a safe number. If they're over 1150, I'm not going to trade them because they don't really have to get them much higher. Look for exercise prices to see what they're doing. Excuse me. I really did just wake up. Water.
That's okay. I feel like I've been up since 5 a.m, so don't worry about it.
Oof. Yeah, it's about when I went to bed. My time though. I think you're on Eastern. So with the D-SPACs right now, we have 3 basic plays that are coming out the gate. So they either spike and go crazy, or they die, or they're just boring. It's going to be one or the other. The boring ones, there's generally a lockup. And if the company doesn't have to move it, they're not going to. The ones that I love are the ones that die. So they're chilling at $10. They de-SPAC, and they just out the gate fall.
All right, I want to bring up some examples here. Where are my charts? Come on. So like a Wejo, is that one you're thinking of?
I'll give you a more recent one today. QNGY. Or Dave, D-A-V-E.
All right. Dave, I know. Let's go to Dave.
Let's do Dave.
Yeah, Dave, I know. Yeah.
Let me pull up the chart also.
All right, I've got it up on my screen here. Oh, wait, I'm not sharing it. Come on, hold on. Let me share my screen with you all so you can see what I'm seeing. There we go. Okay.
Yes. All right, so all that boring line, that's as a SPAC. SPACs are going to hold like $10. That's what they do. They have the redemption, like 9 or 950 is generally the base on that. So that's safe. They de-SPAC, and all of a sudden we're in no man's land, and they die. And this is the part that I love. So Dave dropped to 9. There was a pattern in 2021 where they would hold at 9, maybe get to 8, and then they would reverse. So we started watching Dave at that point. And then we have that knife. And anybody who follows me on social media knows I love knife day. It's normally on Thursdays. And that's when I really start watching these, when it has that knife and it just dies. So then I went the basing. So how we've got, a few days of basing around 5. It actually went into the 4s, I believe. And yeah, we've got 480, 490. I
think the low was 470, 462. And then,
hang on, let me pull
for a couple days there.
Yes. So when it hits that, I actually have my line drawn at 470. So it looks like that's where I got in on it. But that consolidation for a couple days, that's what I'm looking for. and then we have the run. Now these guys had to run their 1150 to do the warrant conversion. So I know at some point it's got to get back up to that level. Now the key on these is, of course, trying to get in as low as possible and respecting your stop losses if not. If you get in and you're kind of, well, it might go lower, put in a hard stop. It's going to save you in the long run, and we make it happen. Goes lower, cool, you can get back in. You're not stuck in it. I hate looking at red on my screen, even if it's a little bit. So I'm happier just to cut it and try to get back in later.
Aly, real fast, can you just like fiddle with your mic a little bit? Because I'm getting some crackling. I think it might be... I'm not sure.
Is that better?
There might be a loose connection somewhere. I still hear you very clearly, but it's probably I deal with that crap all the time.
Gotcha.
But what I'm curious though is like you said 470. So like define your entry for us. How did you know when to get in here? And also where was your stop?
So my stop is normally within 10 cents of getting in at the very most.
Tight.
Very, very tight. And it's just because I have so many statistics on these knifing.
Okay.
That's what they do. With the IPOs, there were so many of them in the threes that were holding in 2021, and now they're sitting at $1. So that would have been dangerous. None of them have run yet. So we know they're going to run, but having a stop loss and just letting it go down, consolidates, getting back in, another stop loss just in case. There's a couple of the ones in January. I hit stop losses like 4 or 5 times, and now I'm back in at $1.30 or $1.10, and they have these redemptions or the conversions at 5, 7, 10. We know they've got to get there. It's just a matter of waiting.
Wait, but how did you know when to get in though? Is my question.
So the double bottom. And that's something that I started doing. I actually have a line drawn on the screen at 470 because the first candle on the 10th dropped. And then the second one, the next day, dropped again. And that was at 480. So I have people that make fun of me for this. I do ghost orders. So they're the really low ones that fill ridiculously early in the morning. And that happened to be one of them. So the 470 was my first entry.
Wait, time out. Wait. What is a ghost order?
Basically, I'm not going to talk about share numbers, but I put in an order that is high enough, so it hasn't gone to the low previously, but to me, it seems reasonable. If you look at the chart, we've got 3 days where we had... What was it? I don't know. Okay, so I don't do the whole wick thing, but it had, if you go to a 4 hour on it, we had that long wick first thing in the morning. The second day bounced right at that line at 480, and then the third day. So the third day is when I'm looking to get in.
Zoom.
Yeah, zoom in.
Zoom way.
Yeah, right in there. So by, I definitely just went to move my mouse on my screen. All right, so see where we have...
Right there.
Yes.
That's what you're saying. Okay.
Yes. So that consolidation, and Dave is just one of those, like, it's one of so many of them that does the consolidation. I generally want a 3 to 5 day on these. This one happened to be a 3 day. We've had a couple of others recently that are on a 5 day, and I'm trying to build my position within that. So I'm not going to go all in on that first candle. I'm going to go a starter on it and see. And
then, whoa, hold on. So, and then you, there we go. So you buy down there. You're out now, I presume?
Oh yeah, I'm definitely out. With this one, I actually only held it back to 10. There's no point for me to hold it much higher, especially when it's doing this slow walk.
I like that.
The second consolidation, I'm done with it. There's no point. Yes, a lot of these can run to just crazy levels. We have a couple yesterday that were 30, 60, 108. I am never going to hold to that. I like exercise prices, and then I go to the next one.
I like that because you're not like, oh, but it could go to 20 and I don't want to miss that. No, take your gains and run. Yeah. Real fast, Aly, I'm just gonna move you backstage for a second. Can you just like check your mic connection and just unplug it and plug it back in because we're getting some pretty significant crackling here on our end. So I think you probably have a loose wire somewhere along the mic connection.
All right.
Here, I'll move you backstage and I'll let you do that. Okay, I've never heard that strategy before. Also, am I the only person that never heard of a ghost order? If I'm the only person that never heard of a ghost order, then fine. But I hope I'm not, because I'd feel silly. Okay, and if you have any questions for Aly, by the way, guys, drop tickers in the chat. We have a couple minutes left that we're gonna hang out with her. Okay, Aly, I'm gonna bring you back on. How are we looking here? How do we sound? Just okay. Yes, that does sound better.
Okay, I have a new laptop, and the connections are like, you know how wires go. So
I know how wires go. Okay, so this was one example of the de-SPAC trade.
Yes.
But that's do you trade? Are there multiple patterns you found with de-SPACs, or is this just the main?
This is the one that I like.
Okay.
And then we've got a couple others. We have the ones that just spike out the gates. We had a couple of them yesterday, and honestly, I didn't play them when they spiked out. So yeah, I don't remember the tickers. I'm that person. Once I stop trading it, I kind of forget what it is. That's why I had to look on the screen to see what I'd played. Not getting attacked is huge. Here's
an interesting question. Where do you get how do you find your de-SPAC tickers?
So SpacTrack.io, and it used to be SpacTrack.net, and I found him a while ago, and great information. You can download everything if you're on the paid version of it. So what I'll do is actually track the SPACs, because there's a delay between the vote and them being listed. So you have to know what's going on with the SPACs, know when the merger vote is. I track the ones that are already in a definitive agreement, because then we have a specific time frame. I'm not waiting for them to find a de-SPAC company, or, because that can take, for some of these, it's a year. I don't want to wait that long. I'm not going to worry about it. Download the def agreements and see what we've got going soon. He posted completion dates. That's great. I love it.
Do you trade the warrants at all?
Yes.
This is coming from the chat, because that would make sense here. That would make more sense, actually.
So that might be actually from one of my guys. They love that. They love that I trade the warrants. So yes, I do trade warrants. I have obviously the brokers that I can trade them. And what I'll do is wait until these companies get to lows. And if I'm not sure it's actually at a low, a lot of times I'll throw a starter and I just let it sit on the bid on the warrants. One of them right now is CPTNW. And if you look at the warrants, they're ridiculously cheap. And I mean, so is the ticker, but they're just going. And it looks like I made money today. Cool. So I haven't logged into anything. I sold QNGY and what was the other one? NRGV this morning, and went right back to bed. My room actually blew up my phone trying to wake me up. And I'm like, yeah, I'm awake. Okay, I'm selling. So yeah, cool. I haven't sold that yet. I should probably log in and check that. But the warrants are great. In my tracker, I track all the warrants also. And anytime they're just knifing is a huge thing for me. So they hit a couple knives. The primary ticker hits a couple knives.
When you say knifing, is that just your word for a big red candle?
Huge red candle. Yes.
Okay.
IPOs do that also. So IPOs, that third knife is where I'm generally looking to get in. I know it's totally a mind blown thing. Also,
I'm mostly with you here, Aly. But the one thing you keep saying that I'm having a hard time here is how do you know when the stock is bottomed?
You know,
you don't.
You don't.
Right.
That's why you use stop losses.
Okay, that's fair. I mean,
I don't like anxiety. I don't like anything risky, which is crazy because I'm a trader and it's all risky. But if I have a stop loss, then it doesn't matter if I sleep in until 25 minutes ago.
That's true.
If it hits, it hits, and then I get back in.
That's fair. Your stop losses, you said always around 10 cents. Do you overdo like a percentage based on I don't want to lose more than 10% or 5%? Okay. Cool.
So normally it's actually 1% when these are lower price tickers. I know. I know. So I'll set them at.
Wait. How do you not get shaken out all the time though? That seems like I guess you don't. You must not. But I mean, if it works for you, great. But that seems like it's so tight to me.
I get in on reversals. Yeah,
Okay.
I get in on reversals. That is the key. And that's something that I've been trying to beat in everybody's heads. If you're trying to get in as this is going down, of course you're going to hit every single stop loss. If you're trying to hit the dead bottom, you're probably not going to, because it's a totally mental thing. If you catch it on the reversal, once it's double bottomed or triple bottomed or consolidated for 4 or 5 days, and it's obviously going back up, then you have that leeway to get in and to add on the way up. I have zero issue raising my average. That's not my problem. I don't want to be in and be like, oh, I got to average down. I got to.
I think it's funny when people when people are afraid of averaging up because don't fuck on my cost basis. Screw your cost basis. Are you making money or not? Like, what are we talking about here? We're talking about your cost base? You care. Why? So you can brag to your friends? I mean, come on.
Yeah. To me, if you're averaging up, you're in the right place at the right time. And it has nothing to do with being right. It's being in the right place at the right time. And then you're good to go. Like, just make it happen. Yeah. And be patient. That's another thing with us. Be patient. So many traders are not patient. Drives me crazy.
All right. Oh, wait. I'm dropping the links to Aly's Twitter. Is that your main platform, Twitter?
Trading Fit Girl is actually on everything. So I have YouTube. Okay. I have my guide on Vimeo. You can find me literally Trading Fit Girl on everything in my life.
All right, guys, I'm dropping the link to that in the chat right now. There it is. So check it out. At Trading Fit Girl across the board. Okay, so we went through the Spac. The Spac strategies. That's interesting. Let's do like one more. Whether it's I don't care. IPOs, uplifts. No, let's do uplifts. This should be good. So I want to hear how you trade these uplifts.
Okay, so uplifts have to do with the lockup expiration, and I know that completely blows everybody's mind that these stocks don't move unless the company wants them to move, or the underwriter, or whoever's running them. So we have so many people want to get in on day one. Don't do that. That's not the time. Let them die. Let the influencers, have fun with them, because they're all low float. We have so many rooms and influencers that are on these because, it's a low float. Well, yeah, it's a low float, but that means that these rooms can actually mess up the cycle on them. So CELZ is a perfect example. If you want to pull that up, I'm going to pull it up here also.
CELZ.
This was one that I played the waves on, and it's actually a chart that I would generally avoid just because
holy crap.
It's messy. It's so messy. So
this was a stock that traded on the OTC markets and uplisted to the NASDAQ it looks like in November.
Yes. So we still had a lot of influencers on these at this point, and they would just run out the gate and then they would die, because that's what they do. And you can see almost exactly where the pushes were and the tweets are if you look on a daily or a 4-hour. So the key to playing we'll call them pumps, because they really are, the influencer pumps, is going to be wait for that consolidation. You can see day 3 through 6 on it. It basically was in a nice little channel under 2. We know that they have to go higher eventually. So the list price is always my key. I'm checking exercise.
Why do they have to go higher eventually?
So the companies that do the offerings, or all companies do offerings, I don't know, I said that do. There are exercise prices that are attached. The exercise price is when whoever's holding the shares has agreed when it hits that price, they're going to go ahead and sell or convert. So anything that has warrants that are convertible at whatever exercise price, they can't dump those. Warrants can't just be sold into the market. They have to convert them to commons. So say it's $5. They've got to wait until that price gets up to $5. Then they can convert to their commons, and then they can actually make money and sell their commons. So things that I pay attention to, exercise prices, and sometimes they're different for the conversion of the warrants and then the common shares. So really want to pay attention to where those are at. Some of them recently, they have their list price at, $3 or $5, and they can convert it like $1.50. I'm avoiding that one. That's just dumb because cool, it's a short. I'm not a short. So
Yeah.
I call them, hey, this is trash. It's going to go down, and go from there. Those I avoid. But this one was a scalp play for me. I did a couple swings on it when it was consolidating. We had 2 different spots on it that just right out the gate, it died, consolidated, spike. That was a room that day. And then it came back down. I waited for it to consolidate again, and then it ran. I actually sold out at 3. It looks like my order entry was 211. I like 211 and 222. It's my thing. I don't know why. And then I just sold it at 3. So I probably sold it when they really started hitting it, because I know how quickly, once we have influencers on these, how quickly they can rug pull. So I'm going to take a scalp and get out.
All right, I dropped the link to Aly's Twitter in the chat. On that Twitter profile is a link to the rest of her
chaos.
Her chaos. There we go. All right, Aly, I know you just woke up, so I appreciate you spending the first part of your day with us. We'll love to have you back, but have a great weekend.
Awesome. Thanks, Spencer. You too.
All right. And hopefully next time we can get the mic situation worked out. But I sympathize with new equipment, because new equipment can be buggy. All right, here's the deal. We're going to hop off. We're going to wrap this show right now. As I mentioned, no Moon or Bust today because the guys are in Denver for the ETH Denver conference. So I will catch you guys in, an hour 40, 3:30 p.m. Eastern time on Benzinga at the close with Joel and myself. I feel like I've been on live all day today. So that's a wrap. Thanks to our guests, all of them. Thanks to Aly. Thanks to Tim. Thanks to Jesse. Thanks to Steve. Thanks to all of you in our chat. Some housekeeping items before we go. Housekeeping item number 1. I'll be back live here tomorrow. Yes, tomorrow on Saturday. If you have not signed up for the Benzinga Bootcamp, you really, really should. Where is the link for it? Is that it? Yep. It's a free event. That's not the thing I want to share. Hold on. Let's try that again. Free event, but signing up gives you access to the recording after the fact if you want to rewatch it. Here it is. BenzingaBootcamp.com is the link. It's free tomorrow all day. YouTube.com/Benzinga 9. I know it says 5 there, but it's actually 9 to I think 3 or 3:30 tomorrow. I'll be your host. We got a full day of education planned. Look, there I am. Peter Brandt, long-time veteran of the markets. Dave Mazza from Direction, Gianna DePoci, Mark Petrino, Nick Shaheen, although that's actually a paid session there. Jim Cagnina on how to trade futures at noon. And Marie Band, when to cut your losses. We could all learn a thing or two about cutting losses and when to do that. Chris Preble from Schaefer's on option strategies. Chris Capri using options as a hedge. So again, great day of education all day tomorrow. YouTube.com/Benzinga to watch it live. BenzingaBootcamp.com to register and get the recording after the fact. Check that out. Second thing I want to say is Benzinga Pro is the main platform that we use for all of our news and research and tools here at Benzinga. If you want to get 25% off, I'm going to put the link in the chat right now to do that. It's on the screen, but click on this link in the chat to get 25% off Benzinga Pro right off the bat. You should do that. Third thing I want to do before we wrap up here is we haven't even looked at the crypto heat map today. So why don't I pull up the crypto heat map and we can do a quick crypto update. I have a hunch of what color it is. So let's do that right now. All right. Here's my heat map. Oh, yeah, I was right. I was right. All right. Yep. It's a risk off kind of a day, which means any risk on assets are going to trade down. Crypto is a risk on asset. It's a growth asset. It trades with tech. Tech goes down. Crypto goes down. Oof. Always interesting to watch crypto into a long weekend, right? We're off on Monday, obviously. But crypto can do some funky things in long weekends when the stock market's closed. Regardless, if you want some free Bitcoin, go to the Voyager app, sign up, use the offer code ZING, Z-I-N-G, fund your account with $100, make a trade, and Voyager will send you $50 in free Bitcoin just for signing up. Check that out. All right, let's see. I plugged the boot camp. We did, yes, what we're doing at the close today, Proton, 3:30. I plugged the boot camp. I plugged Pro. I did the crypto update. How are we doing on the like front? 80, 82? Oh, let's get to 100. Come on, nice round number. Let's get to 100 likes. Hey, I see a few people in the chat have become YouTube members. Shannon C., YouTube member. If you want to become a member of Benzinga's YouTube community, click that little join button that's on the YouTube page right there. Right now, we only have one membership tier. It's $4 a month, and it's gives you access to custom emojis. There's an emoji of me, of Aaron, of Luke, of Mitch, and there's one more, I think I'm forgetting. We'll be adding more stuff, though. We'll be adding more emojis. We'll be adding more perks. We will eventually be doing days where we only produce content for our YouTube members, and there will be days where we will block the chat, so only our YouTube members can chat. That's a little bit ways out. But that's the direction we're going with this. So check it out, youtube.com/Benzinga. Click the little join button and become a YouTube member. And we appreciate all of our members right now. And now I think I can wrap. So hit the like button. We're at 86 likes right now. I think we can maybe get to 100. Benzinga Pro. Anthony says rude. Anthony, why am I rude? I don't think. What was I rude for? I don't think I was rude. What was I going to say? Oh yes. PSA. If you see anybody posing as Benzinga in the wild, email us scamreports@benzinga.com. We will take care of it. But we've had some reports of people pretending to be us. We will never DM you asking you to give us the crypto. So that ain't us. Yeah, eventually, Anthony. Not right now, but eventually. And it won't be like a permanent thing. It'll be like a 1 day a week thing. But that's not. We're not doing that right now. But that is the end game. The point is, we are still figuring out how to add value to the YouTube membership. We've got emojis, but it'll build out into more content. So, no, Paul, that was not us. You should look into that if I were you. You should look into that. All right. I made it to 2 o'clock. I'll catch you guys in an hour and a half for At the Close with Joel. Everyone have a great time between then. And let's end the show today with a commercial for Benzinga Pro. It is the core of this company.
Did you know nearly all stock price changes of 10% or more result from a single news headline? That's right. News headlines have a unique ability to drive stock prices up or down. These news catalysts create trading opportunities every day. All you need is a little help to reach out and take them. And if you're looking to grow your portfolio, it doesn't matter if your investment budget is small or big. An easy-to-read stream of news headlines will increase your opportunities to profit from price changes in the stock market, consolidate a knowledge-based investment strategy, and grow your portfolio. All you need is Benzinga Pro and its powerful news alerts, price tracking, and portfolio monitoring to make a positive change in your trading performance. We've already helped thousands of retail traders across the world, and they could not be happier. Increase your market knowledge, boost your exposure to big movers, and make informed trades before major price changes. The opportunities are all around you. Subscribe now, and we'll skyrocket your portfolio today.